Hello friends, ICAI has released the RTPs, right? So we are going to have a look at the RTP for SFM, our CA final subject which I teach, and believe me, the RTP is taken directly, almost every single question, not almost, every single question is something that we have already covered in the class. So let us go ahead and have a look at it.
To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
So friends, now let us look at the next problem. Rahul Limited has surplus cash of 100 lakhs and wants to distribute 27% of it to the shareholders. Okay, 100 lakhs wants to distribute 27%. Okay, let us remember that. The company decides to buy back the shares. Acha, so distribution means they will buy back worth 27 lakhs worth of shares. Okay. The finance manager of the company estimated the share price after repurchase is likely to be 10% above the buyback price if the buyback route is taken. Acha, so they have not given what is the buyback price, but he says that after repurchase, the price will be 1.1 of whatever is the existing price. Achha. After buyback, the price will be 1.1 of the existing price. Okay. The number of shares outstanding is 10 lakhs and current EPS is rupees 3. Okay. Currently, there are 10 lakh shares. We don't know the share capital value of share per share, that is all not there. EPS is 3. Okay. You are required to determine the price at which shares can be repurchased. If the market capitalization of the company should be 210 lakhs after buyback, the number of shares that can be repurchased and impact of share repurchase on the EPS, assuming that the net income is the same. So friends, first let us write down the data. Rahul Limited surplus cash. So given surplus cash is equal to rupees 100 lakhs. Distributes 27%. So buyback value is equal to rupees 27 lakhs. Okay. Price of buyback or pre-buyback, post-buyback, we are not aware. So price current is equal to, let's say, P. After repurchase, it is likely to be 10% above the buyback price. The buyback route is taken. Okay. So post-buyback price is equal to 1.1 P. Okay. Number of shares outstanding is 10 lakhs. They have given the number of shares, right? So shares outstanding is equal to 10 lakhs. EPS 0 is equal to 3. So friends, now this is the given data. What is part 1? What are we supposed to find out in part 1? What is the question that they have given? The price at which shares can be repurchased, the market capitalization of the company should be rupees 210 lakhs after buyback. So, given this data, the key thing is current price is P, post buyback price is 1.1 P. So, if you were to basically try and compute the number of shares, right? That is the first part that we have to do. Current shares is equal to 10 lakhs. Shares repurchased. This is, you have 10 lakhs, you are spending how much money? You are actually spending 27 lakhs. Rupees 27 lakhs is spent on buying the shares at some price. What is the price? We don't know. What is the price? We have assumed it as P. Divide by P. So, outstanding shares post buyback will be 10 lakhs minus 27 lakhs by P. Okay, so this is the outstanding shares post buyback. Given this is the outstanding shares post buyback, what is market cap they have given? Market cap they have given as rupees 210 lakhs. Market cap is outstanding shares into price per share. So what is outstanding shares? 10 lakhs minus rupees 27 lakhs by rupees P into price per share. What is the price per share? This is post buyback market cap. Right? Post buyback market cap is rupees 210 lakhs. So the price per share post buyback is how much? is 1.1p. So you multiply it by 1.1p. Okay, this is rupees 1.1p. Okay, so rupees 210 lakhs is equal to, you cross multiply and solve for this, you will get 10 lakhs p minus rupees 27 lakhs divided by rupees p into 1.1 p. So p get cancelled. This is also rupees, by the way, into 1.1 p. So rupees p get cancelled. Right. So rupees 1. So you will get rupees 210 lakhs is equal to, this price is in again rupees, right? So rupees 10 lakhs p. So into 1.1. So this becomes rupees 11 lakhs p minus 1.1 into 27 minus rupees 29.7 lakhs. So rupees 210 plus 29.7. So rupees 210 lakhs plus rupees 29.7 lakhs is equal to rupees 11 lakhs p. Right. So this is rupees 239.7 lakhs divided by rupees 11 lakhs is equal to p. Correct. So 239.7 divided by 11. So p is equal to rupees 21.79. Okay. The price is 21.79. Here I don't think there will be rupees here. Is 11 lakh p minus this. Yeah. So this price is 21.79. So the current price is 21.79. This is the same price at which it will be repurchased. So this is the first part of the answer. The price at which shares can be repurchased is 21.79. Second part, number of shares repurchased. We have that already here. What is it? Shares repurchased 27 by p. That is equal to rupees 27 lakhs by rupees 21.79. That is 27 lakhs divided by 21.79. That is 123,910 shares. Okay. So you will buy back 1,23,910. What is the third part of the question? The net impact of repurchase on EPS assuming the net income is same. Acha. EPS current is equal to 3. Current shares is equal to 10 lakhs. So net profit is equal to 30 lakhs. Correct? That is what they said. Now if the net profit remains same, share count post buyback is how much? Is equal to 10 lakhs minus 123,910. That is equal to 8,76,090. Correct? 76,090. Correct. So revised EPS is 30 lakhs divided by 876,090. 3.424. Revised EPS is 3.424. Impact of share repurchase on EPS assuming net income is same. If net income is same, EPS will go up from rupees 3 to rupees 3.424. Okay, so it will go up from rupees 3 to 3.424. So this is the solution. So friends, let us look at the next problem. ABC Limited has rupees 300 million 12% bonds outstanding. 300 million, that is 30 crores. With 6 years remaining to maturity. Since interest rates are falling, please note, ABC is contemplating refunding these bonds with a 300 million issue of 6-year bond carrying a coupon of 10%. So actually the word should not be refunding, refinancing the bonds or something like that. It should be refinancing, not refunding. But anyway, they've used the word refunding because they want to repay these existing bonds and raise fresh bonds. issue cost of the new bond will be 6 million and the call premium is 4%. Okay, so the new bonds you will have to issue them, the cost of issue of new bonds is 6 million and call premium. What is this call premium regarding? The call premium is for the older issue. Why is there a call premium? So, based on whatever is given here, it appears that the old bonds carry a call option. Call option is the company can call back the bonds and repay the money. But whenever they call, they have to repay them at 4% premium. Whatever is the face value, they have to pay 4% higher than that. Rupees 9 million being unamortized portion of the issue cost of old bonds can be written off no sooner than the old bonds are called off. Okay, so this is an unnecessarily complicated statement. Basically, they have 9 million unamortized cost of old bonds which can be written off on redemption of old bonds. Correct? Okay. Marginal tax rate of ABC is 30%. You are required to analyze the bond refunding decision. Okay, this is actually a very good problem. There are 2 or 3 issues that you need to remember in this. One is of course this unamortized portion. Then there is this tax impact. And I think we have to analyze, do a proper cost benefit analysis of what is the cost versus what is the benefit, right? So, if you remember your costing or, CMP subject, even in inter-level, whatever you discussed, there is something called cost benefit analysis. Cost benefit. Cost of refinancing and related expenses and issuing new bonds. Benefit from interest rate savings on new bonds. Both of these will have to consider tax impacts also. We will see that. But the fact is, you are supposed to compare 2 things, cost and benefit. Whether what is the cost versus the benefit. If the benefit overweighs the cost, then you can go ahead. That is what they have asked. You are required to analyze the bond refunding decision or refinancing decision. You are supposed to analyze the cost versus benefit. Okay. Now let us first list down all possible costs and benefits, and then we will actually be able to solve this problem much faster and easier. Okay. First, old bonds. Whether they are cost today or not, whether they are amortized, unamortized, all of that later. First, let us write down the data given. So, data given. Old bonds. First, you have premia on redemption stroke call is rupees 300 million into 4%, that is rupees 12 million. Okay, this is the premium you have to pay. Then you have issue expenses on new bonds. Is how much? 4%. Issue cost of new bond will be 6 million and 9 million being unamortized of the old bond. Issue expenses on new bond is rupees 6 million. Unamortized expense on old bonds is rupees 9 million. Then what else is given? Tax rate is 30%. Both, see, the old bond is 12% with 6 years and the new bond is also 6 years and 10%. So, years there is no difference and amount is also there is no difference. It's 300, 300. So, it is cancelling each other out. That is, you are raising 300 and repaying the 300. Obviously, there are these, additional premia, gimia and all of that. We will come to that. But broadly, the 300 new will replace 300 old at a face value basis. Okay. Now, what are the other costs or, other data? What is given? Old bond rate is 12%. New bond rate is 10%. Tenure stroke maturity is 6 years. Then tax rate is 30%. So, if you actually write this down, right, this is the only data that is required. And total issue size, total old stroke new bond face value is rupees 300 million. Correct? So, these are all the data points. How many? 1, 2, 3, 4, 5, 6, 7, 8. Only 8 data points. They have complicated it in a, in a manner in which you or probably the student should get confused, but you need not get confused. You first write down all this data, automatically things will come up. So, first cost versus benefit. Now, cost of refinancing and benefit of refinancing. What is the benefit of refinancing? Basically, you will make savings in interest cost. Interest cost, there will be a saving. This is interest rate saving. This interest rate also we should actually take post tax. This costs also we should take post tax. Everything should be post tax. And this interest rate saving, whatever is there, this interest rate saving you should arrive at the present value interest factor of annuity for all the interest rate saving. Because this all is in future. Here, most of the costs are current cost plus future costs minus future savings, if any. Here, we are not referring to interest saving, future interest saving, I will say non-interest. Future non-interest saving. So, see, this I have written for you to understand, okay. This is where the problem starts from. I am still trying to explain the problem to you, which is why I have written all of this stuff, okay. This is for your understanding. Fair enough. Now, let us come down further. Let us first, take the cost, because we said we will go by the cost versus benefit, right. So, cost or total cost. 1. What is the, issue expenses? Issue expenses is 6 million. Okay, before we actually proceed there, I want to actually discuss one very, very important thing or very, interesting thing here. See, unamortized expenses on old bonds. Basically, what expenses? Issue expenses, right? So, old bond also had some issue expenses which is unamortized. So, it is going to be amortized over the balance 6 years. Moment you refinance these old bonds, you are supposed to write off this 9 million which was supposed to be earlier written off over 6 years. So, does that mean that even this 6 million is supposed to be written off over 6 years? Absolutely bang on. That is very, very important. Okay, this is the first part. Second, the cost of new bond will be 6 million, call premium 4%, 9 million amortized portion of the issue cost of old bonds can be written off no sooner than the old bonds are called off. So, do you think that these expenses are tax allowed? Is there any assumption in this that they are tax allowed or they are not tax allowed? There is no assumption. You can make an assumption that there you get tax benefit. So, not only do you have to amortize the 6 million over next 6 years, you also have to you are supposed to amortize 9 million over 6 years, but now you are doing only 6 million. In addition, there is a 6 million cash impact. In addition, there is a tax benefit of both of these. So, you have to consider all of those. That is the critical element. I think there are 2 or 3 more critical elements, but I think that is number 1 critical element in this entire problem. Let me repeat. 1, this 6 million has to be written off. There will be a tax impact. This 6 million will be written off over next 6 years. Then this 9 million which was supposed to be written off over next 6 years is being written off now. There is a tax impact of this 9 million right now. There is a tax impact of this 6 million going forward, and there is also a tax impact lost of the 9 million over next 6 years. Okay. So, if you write down all of that, you will actually understand better, and the same way this 12 million also there is a premium. We can potentially assume that this premium also can be, you can claim a tax benefit out of that. There is a cash flow impact also here. Okay. So, let me first write down cash cost. Okay. Cash cost, premia on redemption, rupees 12 million. Then issue expense, new is rupees 6 million. So, total 18 million is the cash cost, correct? This is the cash cost, right? Then, second part is, what is the tax impact? Tax impact of what all? You have tax impact on this, okay, tax impact of this, but please note, on this 6 million it is over the future, whereas on this 12 million it is instantaneous. Tax impact 1, 12 million premia. Why is this instantaneous? The premia on redemption, why is this instantaneous, and why is this issue expenses over the next 6 years? Because after the issue is redeemed or the old bonds are paid off,
there is no use of carrying this old redemption forever in future. When the bonds themselves don't exist, why will you carry that premium in an unamortized manner on your balance sheet? You will write it off. When you write it off, you will get a tax benefit right now. 12 million premia on that 30% is 3.6 million. Okay, this is tax impact, this is a benefit. Okay, from cost you have to subtract the benefit, please note. Then 2 is, we have already taken the cash cost of this 6 million. Now, 9 million you can write off right now. So, 9 million written off, right, in of that 30%. So, that is 9 into 3 is 2.7 million. This is also another benefit, correct, because you are getting a tax break on this 9 million, no, because we said this 9 million can be written off. That is what they said here, right. This 9 million being unamortized portion of this issue cost of bonds can be written off no sooner the old bonds are called off. So, on the day you call the bonds and money comes back, you can write this off, and when you write this off, we are assuming that there is a tax benefit. So, later on I will write the assumption that we are assuming that there is a tax benefit arising from all of this, but let me first do the computation. Then please note, this 9 million is written off over, was supposed to be written off over 6 years. 6 million will be written off over 6 years. This was supposed to, this will be. See, the same 9 million is now written off now. That is one impact, that is definitely an impact. But there is also a negative impact of 9 million that was supposed to be written off, but is being written off now. So, you have to consider both the factors. If you were to look at it as present value scenario, right, you were supposed to write off over 6 years, but you are writing it off now. Compute the difference. What will you do? You will take the present value of all the cash flows over, or whatever the tax benefit over the 6 years, and you will also take the present value of this 9, which is again 9. You will see the difference between those two, and that is the net gain or loss, arising out of the tax benefit on this amortization, which is happening now instead of happening over 6 years. So, you are computing the tax benefit of that 9 million over 6 years, and now comparing that with 6 million which you are going to get now. Okay. So, this 6 million and this 9 million. So, basically 3 million, right, this 3 million over 6 years, that is 0.5 million per year. I will again write this to you. 9 million over 6 years is what? 1.5, 1.5, 1.5, 1.5, 1.5. Instead, you are getting 1, 1, 1, 1, 1. This is 9, this is 6, right. So, the difference is 3. So, this is 0.5 per annum, right. This 0.5 is actually the expense that could have actually been written off, but you are writing it off less. 1.5 you are supposed to write off, you are writing off only 1. So, you are actually losing 0.5. You are not even losing 0.5, you are losing the tax benefit on 0.5. You are losing the tax benefit on 0.5. So, tax benefit is 30% of this, that is 0.15. So, everywhere it is 0.15. So, present value of tax benefit lost is equal to present value of interest factor till annuity of 0.15 million at some percentage for 6 years. Now, what is this percentage? Here again another twist in the story. Why is there a twist in the story? See, they have said the old bonds you were supposed to, were carrying a coupon rate of 12%. The interest rates have come down. The new bonds are carrying a coupon rate of 10. So, I also told you, if you are issuing new bonds at a face value and they are trading at face value on the day when you issue them, it means that the coupon is equal to YTM, right? The coupon rate is present market rate. So, can we take that the current market rate is 10%? Yes. So, should we discount all future cash flows? So, we are going to do here cost and benefit, right? Everywhere I said present value interest factor, right? We have of the interest rate savings, but at what rate will you discount these? Will you discount this at 10%? Yes, that is one obvious possibility. But please note, everywhere we are taking post-tax numbers, because everywhere I am computing what is the tax impact, tax benefit, tax gain, tax loss. So, everything is after tax. Please remember your CA intermediate FM classes. Wherever you are using post-tax cash flows, you should discount them by post-tax rate, not pre-tax rate. So, you cannot, first of all, you have to make an assumption. Okay, assumption. Since bonds or new bonds are issued at market rate at a coupon of 10%, YTM is equal to 10%. YTM or YTM and market rate and YTM. Market rate and YTM are 10%. This is the first assumption. Market rate and YTM are 10%. Second assumption, post-tax rate has to be used to discount post-tax cash flows. That is 10% into 1 minus 0.3, that's equal to 7%. This is first assumption. This is second assumption. Third also I said there has to be some assumption, no? If you remember, I said we will list out all the assumptions. Yeah, that the new bond issue expense will be written off over 6 years. All expenses written off, that is issue, then premia on redemption, are allowed for tax purposes. Okay. Based on this, here the present value interest factor should be computed at 7% for 6 years. Okay. Now let us compute that. These are all the assumptions that you have to write in the problem. Now let us compute this value and then move forward. So let us compute the present value interest factor of annuity for 7% for 6 years. So 1.07 divided by equal to gives you 0.9345. You have to do this 6 times by 6 years. 1, 2, 3, 4, 5, 6 and then do GT. This will be 4.766 into 0.15. That will be 0.71498 or we can take 0.715. Now, this 0.7515 is what? 0.7515 is the tax benefit lost or tax benefit lost, that is a cost. Whereas these two are tax benefits, these numbers, this is 2, this is 3. So, we are still in the cost computation. In cost 1, there is cash cost of 18, then there is a tax benefit arising out of, these are all cash cost, okay. Then there is a tax benefit arising out of whatever money that you have actually spent or writing off. Then there is a tax loss of the old versus new write-off of issue expenses. You are computing a present value of all the issue expenses that could have actually been amortized and the difference of issue expenses that could have been amortized and arrived at a value of 0.715. So, total cost is equal to 1 plus 3 minus 2. Why am I saying plus 3 and minus 2? This 3 is cost, whereas 2 are tax benefits, tax impact stroke benefits. Right. So, that is 18 plus 0.715 minus 2.7 plus 3.6, right? Yeah, 2.7 plus 3.6, 6.3 minus 6.3. This will be 18 minus 6.3 plus 0.715 is 12.415. This is total cost. What is total benefit? This should be an easy one, because everything we have considered into cost, what else is left? The only thing that is left is interest rate differential. So, 12% versus 10% for 6 years on 300 million discounted at 7%. Present value factor, interest factor of annuity for this. This all is total benefit. I have written it in a lengthy form. So, it is interest saving is per annum again. Okay, let me say per annum is equal to 300 million into 12% minus 10%. That is 2%. 2% on 300 million is 6 million. Okay. This interest saving is pre-tax. Post-tax interest is 6 into 0.7, that is 4.2 million. Okay. interest saving, present value of interest saving for 6 years is present value interest factor of annuity of 4.2 million for 6 years at 7%. Again, why am I taking 7% even though I have considered 12 and 10 here? This 10 is the key rate, this is the market rate, and market rate is pre-tax and we have to take post-tax. Now, some of you may get a doubt, where have they said anything about this being pre-tax or post-tax? My dear friends, whenever bonds in coupon rates are given, they are always pre-tax, they are never post-tax. Here, because they have given us the tax percentage, you are supposed to compute it post-tax. Okay, so what is the present value interest factor of annuity of 7% for 6 years? I think we computed it somewhere, no? Let me go above. Yeah, it is 4.766. So, 4.766. That is 4.2 million into 4.766. That is 20.017 million. This is benefit. Cost, benefit minus cost is 20.017 minus 12.415. Minus 12.415. How much does it come to? 7.6022 net benefit. So, this is million. Please don't forget the nomenclature or units of measurement, rupees million. Since the net benefit is rupees 7.60 million, the company should go ahead with refinancing. So, friends, in the study material, this present value of this differential is basically a loss, right, or the cost, right. This cost, what have they done? They have actually taken this part of the benefit. So, they have subtracted this from this 20, whatever you are getting this 20 here, right. From this 20, they have subtracted it. They have taken it as part of the P&L and you know how they get the tax break and all of that. The logic is same either ways, whether you do it this way or whether you do it that way, the logic is same. But here the key factor is you have to consider all the aspects. You have to recollect, you have to rather remember where does each line item have an impact and what is the tax rate, discounting rate that you have to use. So, I would actually think that it's a very well structured problem. They could have made it simpler. Whether you solve in the, what the manner in which the institute has given or the way I have given, if you have understood the concept, both of them are same. Let us look at the next question, friends. Amal Limited has been maintaining a growth rate of 12% in dividends. Has been maintaining, okay, please note these words, has been. The company has paid dividend of rupees 3 per share, okay. The rate of return on market portfolio is 15%, risk-free rate in the market has been observed at 10%, beta coefficient of company shares is 1.2. You are required to calculate the expected rate of return on company shares CAPM as per the CAPM model and equilibrium price per share as per the dividend growth model. Okay, they have combined two things here, but first let us put the data, then we will understand the question much better. Amal Limited, those are all irrelevant, has been maintaining growth rate of 12% in dividends and that has been maintaining. So, can we assume that is expected to maintain? So, G is 12%, has paid, D0 is equal to rupees 3. This implies D1 is 3 into 1.12, which is 3.36, right. Then the rate of return on market, return of the market is 15%, RF is 10%, beta of Amal is 1.2, okay. Now you have the data. Now let us understand the question better. You are required to calculate expected rate of return on company shares. Expected return, we know the formula. Expected return is risk-free rate plus beta into return of the market minus risk-free rate, okay, as per the CAPM model, and equilibrium price per share as per dividend growth model. What is the price per share as per dividend growth model? P0 is equal to D1 by KE minus G. So, I think, yeah, okay. Right. So, we have G, we have D1, we need to find out KE. This KE is same as this ER.
Expected return, basically your cost of equity is what is expected as a return from the equity. It is not ROE, okay. ROE is a book value metric. This here is the market value metric, okay. So now we have to find out expected return. Expected return for Amal Limited is equal to 10% plus 1.2 into 15 minus 10, that is 10 plus 1.2 into 5, that is 10 plus 6, that is 16%. Okay, first part is over. Then price of Amal shares is equal to D1 is equal to D1 by KE minus G. KE is equal to expected return is 16%. So P0 is equal to 3.36 by 16% minus 12%. That is 3.36 by 0.04, which is 3.36 by 0.04 is rupees 84. The price per share or equilibrium price, you can call it equilibrium, that's what they said, right? Equilibrium price per share is rupees 84. Fairly simple problem, they can mix two concepts in between, right? Fair enough. Let us move to the next problem. A Limited has an expected return of 22% and standard deviation of 14%. B Limited has an expected return of 24% and standard deviation of 38%. A Limited has a beta of 0.86, B Limited has beta of 1.24. Correlation coefficient between A return of A and B is 0.72. The standard deviation of the market return is 20%. So basically, they have dumped data on your face. Okay, you first let us list down the data, then we'll understand half the questions, whatever the questions are. Is investing in B Limited better than A Limited? Let us see. Once we fill the data, we'll know. If you invest 30% in B, 70% in A, what is your expected rate of return in portfolio standard deviation? Very simple. What is the market portfolio's expected rate of return and how much is the risk-free rate? What is the market portfolio's return? What is the market portfolio? Market portfolio is basically you have to find out, have they given anything else? The standard deviation of the market return is given, right? So, a market portfolio is what? A market portfolio is where beta is 1. Right, so you have to just find out return of the market, that's all, there is nothing else you have got to do. And how will you find out return of the market here? We will come to that, we'll figure that out. Then what is the beta of portfolio if A Limited's weight is 70%, B Limited's weight is 30%, okay, fine. So I think most of the questions we will easily get, only this third question just we'll have to figure out what it is because there's too much of data above and we'll have to figure out what data is required for question number 3, but otherwise it is a fairly simple problem. Let us first write down the formulae, as I said earlier, right, so that whenever we are solving problems like this, it is good practice to first write down all the formulae so that you are very, very clear of what you are trying to solve. First, is B Limited better than A? I don't know, we'll have to see. You are investing 30% in B, 70% in A, what is expected rate of return and standard deviation? Okay, so standard deviation of portfolio or variance of portfolio is A square, weight A square plus variance B square, variance B into weight B square plus 2 correlation. So, one more thing friends, correlation can be represented by R or by something called as rho. Okay, there is this, it looks like a small p, okay, different people use different connotations. R is also correct, rho, it looks like p, it is called as rho. So, this is also correct. Okay, so I am more comfortable with R, it is easier to remember, correlation R, that is how, because R square is also a term that we use in statistics which is linked to correlation, which is why I remember R, okay. 2 are standard deviation A, standard deviation B, weight A, weight B, okay. So, this is portfolio variance and portfolio return, expected return of portfolio is sigma weight of each individual stock and return of individual stock. There are no probabilities and all that, so it is fairly simple. What is market portfolio's expected rate of return? Risk period, we will come to that. Beta of the portfolio, if A is limited, weight, yeah, beta is also same simple thing. Beta of portfolio is sigma weight of individual stock into beta of individual stock, right? And I is equal to 1 to n, I is equal to 1 to n.
Okay, so these are the formula that we are going to use. Let us first start off. Let us, even before we actually solve problem number 1, right, I actually want to put down the data because there's way too much of junk data, boss. I mean, we really don't know how much of it is actually useful, how much of it is useless. So it is very, very important to write down the data. Okay, so A limited, B limited, expected return, then standard deviation, then what have they given? Beta, then correlation coefficient, then they have also given market. Okay, A limited expected return is 22%, standard deviation is 40%, B 24% and 38%. A has beta of 0.86, B has beta of 1.24, correlation coefficient A and B is 0.72, standard deviation of the market is 20%. Okay, now first we have noted down the data. Now what is the first question they have asked? Is investing in B limited better than A limited? B has lower standard deviation and higher return. So on the face of it you can say actually first question is a sitter. Sitter means very, very easy. Yes, investing in B is better than A as it has lower SD and higher return. Simple. First question is it like a full toss. In cricket, there is it's a full toss. Right, now let us come to the second question. If you are investing 30% in B and 70% in A, what is the expected rate of return and portfolio standard deviation? Okay, so we noted down the formula 30 and 70. So A is 70% and B is 30%. Right, then expected return is equal to, it is simple, it is multiplication of both the returns into their weights is equal to 70% into 22% plus 30% into 24%, right. 7 2s are 14, 7 2s are 14, that is 15.4% plus 24 3 is 7.2%, that is 22.6% expected return. Then standard deviation or variance of portfolio, right. Variance of portfolio we have to compute as sigma 1 square, weight 1 square, we have done all of that. So we have written the formula above, so and we have solved enough problems, so I am actually going ahead with the solution rather than writing it down every time, right. So it is what is 0.7 whole square into what is the standard deviation of A? We will take here 40. So these we will take as 0.7, whereas all these numbers will take as 40, because if I take 0.4 then square, it becomes too much of computational issue. So let me directly take 40, right, plus 0.3 whole square into what is standard deviation? 38 square plus 2 into 0.7 into 0.3 into 40 into 38 into what is correlation coefficient is 0.72, 0.72, right. So this is variance of portfolio is equal to 0.7 into 0.7 is 0.49 into 40 into 40 is 784 plus 0.3 into 38 into 38 is 129.96 M plus, then plus 2 into 0.7 into 0.3 into 40 into 38 into 0.72 is 459.648 M plus, memory recall, portfolio variance is 1373.608, or portfolio standard deviation is equal to square root 1373.608, which is equal to 37.0622. So if you see, this is 40, this is 38 and this is 37. So this is percentage. So portfolio standard deviation is equal to 37.06%. Okay. If you invest 30% in B and 70% in A, what is your expected rate of return and portfolio standard deviation? Both of them we've got. Okay. Now coming to the third one. This is what was looking slightly odd to me also. What is market portfolio's expected rate of return and how much is the risk-free rate?
Okay, so they are asking return of the market is equal to question mark. Then they are asking RF is equal to question mark. Okay, so what are they saying? Oh, so this is also where here also I think you have to solve using equations, right? So it is, just look at this, let's just look at this. They have given beta also, right? Yeah, they have given beta. So we have to use the beta and solve for the equation, which is return of what is this? A. Return of A is equal to risk-free rate plus beta of A. What is beta of A? 0.86 into market risk premium. Return of B is equal to risk-free rate plus 1.24 into market risk premium, which is, and they have given return of A also they have given, no, which is 22%, and this is equal to 24%, right? So equation 1, equation 2, 1 minus 2, or 2 minus 1 actually, 2 minus 1 is better, I am sorry, because why am I doing 2 minus 1? This has a 24 minus 2 is better than doing 22 minus 24, okay. So 2 minus 1, you will get risk-free will get cancelled, you will get 2% is equal to, these two will get cancelled, this will be 24 plus 14, that is 38, 0.38 MRP. So, let me eliminate this percentage also, because this percentage business is usually painful. So, 2 is equal to 0.38 MRP, MRP is equal to 2 by 0.38, or MRP is equal to 2 by 0.38 is 5.263, right. So, you substituting in equation 1, right, risk free plus 0.86 into 5.263 is equal to 22, okay. So, risk free rate into 0.86, that is 4.52 plus 4.526 is equal to 22. So, risk free is equal to 22 minus 4.526, which is equal to 17.473. Risk free is equal to 17.473 or 474. Okay, you can round it off. Right, this is risk free rate. Then MRP is equal to 5.263, that is return of the market minus risk free is equal to 5.263, and risk free we have it as 17.473. So, return of the market minus 17.474 is 5.263, or return of the market is equal to 5.263, my handwriting is going bad, sorry, is equal to 5.263 plus 17.474, which will be 22.737. Okay, so we've got risk-free rate and return of the market, we've got both of them. Now coming to the fourth part of the question. What is the fourth part of the question, my dear friends? What is beta of portfolio? Beta of portfolio, where portfolio weight A is equal to 70, B is equal to 30, right. So, beta of portfolio is sigma I is equal to 1 to n Wi beta I, that is 0.7 into 0.86 plus 0.3 into 1.24, which is equal to 0.7 into 0.86 is equal to m plus 0.3 into 1.24 is equal to m plus, memory recall 0.974. Beta of portfolio is 0.974. So, we have solved this problem, fairly simple, right? Let us move to the next one.
Friends, now let us solve one more problem, same variety. This is from practice manual. Basically, old syllabus had something called as practice manual. This is from that. Let us look at the problem. On 1st of February 2012, ABC Mutual Fund issued 20 lakh units at rupees 10 per unit. Okay. Relevant initial expenses were 12 lakhs. It invested funds in capital market instruments to build a portfolio of 185 lakhs. Okay. During April 12, it disposed of some of the instruments costing 60 lakhs for 63 lakhs and used proceeds in purchasing securities of 56 lakhs. Fund management expenses for the month were rupees 8 lakhs, of which 10% was in arrears. Then in April 12, it fund earned dividends amounting to 2 lakhs and distributed 80% of the realized earnings. On 30th of April 12, the market value of the portfolio was 198 lakhs and Mr. Akash and investors subscribed to 100 units on 1st April and disposed of the same at closing NAV on 30th of April. What was his annual rate of earning? Absolutely ditto. The problem is ditto. I'll just solve it for your understanding. Let us start solving this problem. So friends, same problem. Let us start off without further delay. First one is working note 1, cash balance. What is cash balance? We will also put here heading amount is lakhs, cash balance rupees lakhs. Everything will mention in lakhs. Okay. Then what is NFO? NFO was 20 lakh units. 20 lakh units at rupees 10, basically 200 lakhs, right? That will be your closing cash balance. Then after that, what happened? Initial expenses. Initial expenses was 12 lakhs, so minus 12. So you add this to this, right? Then capital market instruments, it invested money in capital market instruments to build a portfolio of 185 lakhs and during the month of April, it disposed of some of the instruments costing 60 lakhs. So we'll split the investments into two parts. Less investment 1 is 60 lakhs, less investment 2 is 185 minus 60 minus 125 lakhs. Okay, and after all of this, what is the closing balance? 128 and 3 is the closing balance, cash, right? It is so far positive. And this 60 lakhs worth of investment, it disposed of at 63 lakhs. So add investment 1 realized is 63. So what is your closing cash balance? 66. Then out of this 63, it used the proceeds to purchase securities worth 50 lakhs. So again, less investment 3 is 56 lakhs. So your closing cash balance is 10 lakhs. What is the next thing after that? Fund management expenses was 8 lakhs, of which 10% was in arrears. So basically 8 lakhs minus 10% is 7 lakhs 20,000. Less fund expenses minus 8 into 90% is 7.2 lakhs. So your closing cash balance is 2.8 lakhs. What is the next expenditure? It earned dividends of 2 lakhs. Add dividends 2 lakhs. So your closing cash balance is 4.8. Then it distributed 80% of the realized earnings. Realized earnings, just like previously, both dividends as well as capital gains. Less dividend distributed, less capital gain distributed. Okay, what is dividend distributed? This 2 lakhs into 80%, right? So I am putting minus so that it is 1,60,000. Okay. So what is capital gains distributed? It is basically your 63 minus 60, right, into 80%. So I have put instead of minus plus because it is in a negative number, okay, into 80%, 2.4. So your closing cash balance is 3.2 plus 2.8 is 3.2 plus 2.4 is 0.8. Then distributed 80% of its realized earnings and the market value of portfolio is 188 lakhs. So this is the closing cash balance. Closing cash balance is 0.8, right? Let us highlight this. Now coming to the next working note 2, NAV, right? What is closing value of marketable securities? They have given it, right? They have given it as 198 lakhs. So 198 lakhs is the value of securities. Add cash balance. How much? Is 0.8, right? Less fund expenses payable, expenses arrears. How much? We had 10% of 8 lakhs which was unpaid. So that is 80,000, right? Minus 0.8. Okay. That makes it total NAV is, you can actually call it the total, so total NAV and NAV per unit. So how many units did we have? 1 lakh or 198 lakhs. What was the initial units? 20 lakh units. So you have to divide this by 20 lakhs. So you basically get 9.9 as the NAV per unit. Let us highlight this also. So friends, now we have completed the working notes. Now let us come to the real final solution, which is computing the return. So computation of return of Mr. Akash, correct? That is the name of our investor. Initial investment. How many did he invest? He invested basically 100 units at initial fund value. So let me put this heading as units, NAV and rupees. Okay. So he invested 100 units at 10 rupees and basically his total investment is 1000 rupees, right? Then what did he do? He got the return. What return? That capital gains and dividend which was distributed by the mutual fund, he also would have got it. So let us take, so income received, CG plus dividend, okay. How do we compute this? See, if you just scroll down or go to our working note where we showed the total amount of capital gains, dividend and capital gain distributed, we basically show or we have 1.6 lakhs of dividend and 2.4 lakhs of capital gains, basically roughly 4 lakhs. Now 4 lakhs is for 20 lakh units, right? So the whole scheme is worth 20 lakhs. So for 20 lakh units, it is 4 lakhs. Whereas our gentleman Akash has 100 units. So how much is the money that he would have received for just 100 units? So let us compute it this way. It is 4 lakhs is for 20 lakh units. So per unit how much is equal to 4 by 20. Okay. Basically per unit it is 20 paisa and he had 100 units. So into 100 he received 20 rupees as dividend and capital gains. Very simple. Okay. Then redemption value. What is the redemption value? He sold off entire 100 units at what NAV? We computed NAV, right? They have not given any number. We only computed working note 2, 9.9 is the NAV. So he sold off at 9.9. So 100 units into 9.9. This is the amount realized or redemption value realized. Okay, let me put it that way. Now what is his return? Absolute return. See, he did all of this for 1 month. That is why I am saying absolute return is amount realized plus any incomes minus your investment value, basically 10 rupees. For all this effort, 1000 rupees he invested, he got 10 rupees as outcome. Okay. So absolute return percentage is 10 rupees on 1000, basically 1%. 1% is for 1 month, for 1 month. So annualized return is this into 12%. Okay. That's all is the answer. So here the answer is 12% is the annualized return that Mr. Akash has got. For all of this, you have to just compute the cash balance separately, you have to compute the NAV value separately and then integrate all of that and use our formulas for computation of return. Return is whatever is your amount realized plus any cash or any incomes received minus the initial investment divided by the initial value of investment. That is your absolute return percentage. Absolute return percentage is what? It is over the period during which all these transactions happen. That you have to multiply by whatever the number is. If the absolute return is for 1 month and if you want an annualized return, you multiply it by 12. If the absolute return is for 3 months and you want for an annual number, you multiply it by 4. Right? Simple as that. So this concludes this variety of problems. Now let us move to the next variety of problems in mutual funds. We'll solve some more complicated ones. There are some complicated varieties, there are some simpler ones also. Let us look at them. Mr. Dayal is interested in purchasing equity shares of ABC Limited, which are currently selling at rupees 600 each. Okay. He expects the price of the share may go up to 780 or go down to 480. Excellent. In 3 months, okay, 3 months. He expects the share price may go up to 780 or go down to 480 in 3 months. The chances of occurring such variations are 60% and 40% respectively. A call option on the shares of ABC Limited can be exercised at the end of 3 months with a strike price of 630. So they have given all the data actually. What combination of share and option should Mr. Dayal select if he wants a perfect hedge? Okay. This is where there is a slight twist. I mean, you have to be careful. What should be the value of the option today if the risk-free rate is 10%? What is the expected rate of return on the option? Is the expected rate of return on the option. Okay. So friends, first let us input the data and we'll understand the question slightly deeper, because I don't think this is the right way of framing the question, but nevertheless, we'll see what it is. Mr. Dayal is interested in purchasing equity shares. So wishes to purchase equity shares. So first, company name is what? ABC Limited. Okay. Then spot S0 is how much? 600. Then share price may go up to 780 or go down to 480. So S0U is 780 and S0D is 480. Friends, you remember this nomenclature, right? From S0, you go up once, it is called S0U. If it goes down once, it is called S0D. From S0U, it goes up once more, it is called S0UU. From S0U, it goes down, S0UD. From S0D, it goes up, it is called S0DU. S0DU or S0UD, both are same. From S0D, it goes down one more level, it is called S0DD. Okay, it is just, one step up is called U, one step down is called D. You keep on multiplying S0 with U and D. And our U and D are numbers which are like 1.2, 1.4, 0.8, right? So it is exactly related to that only. Anyway, I am just trying to clarify this for you. The chances of such variations occurring are 60 and 40%. So 60%, 40%. I have a fundamental problem with this. I will tell you what the problem is. I have a fundamental issue with the way they have given this data. A call option of shares can be exercised at the end of the 3 months with a strike price of 630. So X is 630, expiry is 3 months. What combination of share and option should Mr. Dayal select if he wants a perfect hedge? What should be the value of the option today? Assume the risk-free rate is 10% per annum. RF 10%. RF per annum 10%. What is the expected rate of return on the option? Okay, so I will tell you what is my fundamental issue with this problem. See, when we are given SU and SD or S0U and S0D, what do we compute? We compute the probability. What is the probability? Probability of it going up from current levels. Right? If already probability is supposed to be computed that way, why have they given this probabilities of 60 and 40? Is this 60-40 correct or what you compute there correct? See, what is U? What is D? U is 780 by 600. U is 1.3. What is D? D is 480 by 600. 1.3 and 80. Now, if you have this, how do you compute P? P is equal to E per RT. Now, first let us compute what is E per RT. So, here we can directly compute E per RT if they have not given the number. So, we can take a normal compounding. Instead of doing an exponential continuous function, you can take a compounding method. So, you can take this as interest rate is 10% per annum. So, for 3 months what is it? For 3 months it is 10% by 4. It is 2.5% for 3 months. So, future value factor is how much? 1 plus 2.5% is 1.025. We can do it this way also. If you don't know, they have not given the value of E in this problem, so we can directly do it this way. Now, coming to our question, P is equal to E power RT minus D divided by U minus D, correct? If this is the case, what is the value of P? Here we will, as I said, we can assume 1.05 to be equivalent to E power RT value. 1.025 minus 0.8 divided by 1.30 minus 0.8. So, if you look at the percentage basis, right, the probability of going up is 45%. So 1 minus P will be 1 minus 45%, that is 55%. And these are round numbers actually. So when you are computing value of P, that is probability of it going up and probability of it going down as 45 and 55, what are these values? 60 and 40. This is the problem that I have with this problem. So these 60 and 40 are actually irrelevant, because if you take these numbers, if you take the 60 and 40, then the value of P here should be 60. If value of P is 60 and we know the value of U and D, then e power RT we should find out. But they have already given e power RT, right? So we can choose to ignore these two numbers, 60% and 40%, and actually compute everything as per our normal formulae. That is my suggestion. That is how I would do it. Okay. Now, this is not the problem actually. Okay. The problem has three elements. What are the three elements? Let's see. Part 1. What is the part 1 of the problem? What combination of share and option should Mr. Dayal select if he wants a perfect hedge? So now, this question is out of the park. They have talked about option, they have talked about share, and then now suddenly they are saying that what combination of share and option. So, what are they saying? Mr. Dayal is interested in purchasing equity shares. So, you have to lay more stress on that line. That is, he is interested in equity shares. However, he wants to hedge the equity share. He wants to hedge the equity share. So, how can you hedge an equity share? What hedges an equity share? Please think through. You can enter into a future, no? To hedge a equity share that you already have or you are going to buy. You can enter into a future. You can also enter into an option. We are in the topic of options. So, you can actually, if you want to hedge your position on equity share, you can actually enter into an option. And here, they are specifically saying about a call option. So, if you buy an equity share, will you also buy a call option in order to hedge? You already have a share and then do you want to buy another call option? So, you already have a share, will you also buy a call option? No. If you have an equity share, you will sell a call option. But how much will you sell? There, our concept of delta hedging comes. If you have a call option, how many shares should you have so that there is a perfect movement in the price of the option and the share? That is, the movement in the price of the option matches the movement in the price of the share. That is denoted by delta hedging, or the delta number says how many shares should you have? How many shares should you have such that the price of the option change or the change in the option price is fully hedged? Here they are asking ulta. You have a share, how many options should you have such that, or when I say options you have here, if it is you are already having shares, then you are basically selling a call in order to hedge the share. So, how many, if you are buying one share, how many call options should you sell such that they both are perfectly hedged? So, first of all, we have to take a normal call option, find out its delta, which is the hedge ratio. How many equity shares should you buy? Once you find that out, then you invert it. That is, if you want to buy one share, then how many call options should you sell? Is that the question? What combination of share and option should Mr. Dayal select if he wants a perfect hedge? So, you can say, if he buys one share, he should sell this many options, or if he sells one option, call option, he should buy this many shares. That is what is required. So, let us first find out what delta. So, if you find out delta, first part of the problem is solved. Okay, what is delta? So, delta. We have to first find out delta. Delta is change in option price divided by change in share price. That is CU minus CD divided by SU minus SD. Correct? Now, we have the probability. What is the SU and SD? We already have S0U and S0D. What is the value of the call option when you reach S0U? What is the value of the call option when you reach S0D is what you have to find out. So, we have to find out now what is CU and CD. What is CU? CU is what is the value of the option? If the strike price is 630 and it reaches 780, what is the value of the option, intrinsic value of the option? 780 minus 630 is 150. Same way, what is CD?
The strike price is 630 and the current spot is 480. Is there any value to the option? If you are already able to buy in the market, somebody who has purchased a call is able to buy it in the market at 480 and he also has an opportunity to buy at 630, what will he do? He would rather buy at 480. So, the option to buy at 630 is useless. So, the value of call option at downside is 0. Okay. So, then we again compute delta. What is delta? Delta is equal to, what is CU minus CD? Is 150 minus 0, which will be 150. Correct? Then divided by SU minus SD. What is this? 780 minus 480, 300. So, that will be 0.5, exact 0.5. Delta is 0.5. What does this 0.5 mean? For every call option that you have, if you have 0.5 shares, both of the portfolio of your call option, for every call option that you sell, if you have 0.5 shares, they both will be perfectly hedged. Or for every call option that you buy, if you sell 0.5 shares, you will be perfectly hedged. Now, what are we supposed to answer? What combination of share and option should Mr. Dayal select if he wants a perfect hedge? So, the answer is Mr. Dayal should sell one call and buy 0.50 shares, or okay, if he buys one share, he has to sell 2 calls. Both are same, there is no difference. I have just multiplied the whole value by 2. So, please do not get confused. Mr. Dayal should sell one call and buy 0.5 shares, or if he buys one share, he has to sell 2 calls. So, I have just multiplied the first number by 2, 1 into 2, 0.5 into 2, that is all I have done, nothing else. Okay, so that is the answer to the first question. Now, part 2. Part 2 is, what should be the value of the option today if the risk-free rate is 10%? How do we value the option? You remember our binomial method. You can draw a binomial tree and do it, right? Or you can do a risk neutral valuation also. So, in this case, we can do either. Both of them you are going to get the same answer. Anyway, we have computed the value of P. P we have computed at 45%. Okay, that is assuming you are not blindsided by this 60 and 40. Okay, so you actually write an assumption. Okay, at the end of the thing, at the end of this particular part 2 of the solution, we will write the assumption saying that we have ignored 60 and 40 and have computed probability using the formula e power RT minus D by U minus D. Okay. So, what is the payoff of the call in both the cases? What should be the expected value of the option today? Expected value of the option. What is expected value of the option? Is expected value of the option. What is the expected value of the option? Expected value of the option is P, that is probability, P into Cu plus 1 minus P into CD, whole thing divided by future value factor. Correct? So, how do we compute this? Here we do it as, what is value of P? 45% into what is Cu? Value of the call when the price goes up is 150 plus value of the call when price goes down, I am sorry, into 150 is here, into 150, that is value of the call when price goes up. We computed Cu and CD now already. Please do not forget the risk neutral method, plus 1 minus P. What is 1 minus P? 55% into value of the call when the price goes down, expected value of the share goes down. So, this is first part of the answer, 67.5 divided by, what is the future value factor? We already computed 1.025. Okay. So, this is equal to 6.5 divided by 1.025, you get 65.85. Expected value of the option today is 65.85. If you do binomial tree method also, you are going to get the same thing. You are discounting both the values. This is the same thing. There is no fundamental difference. Then, here as I said, we are going to write an assumption. Assumption. Probabilities
of 60% and 40% provided in the question are not relevant as U, D and future value are already provided and P can be computed from there. Agreed? So, you write this assumption. So that you are very clearly saying that this 60 and 40 are irrelevant. Probabilities of 60 and 40 are irrelevant because we ourselves computed them and we got them as 45 and 55, correct? 45 and 55. Anyway, now let us come to the third one, part 3. What is part 3? What is the expected rate of return on the option? If you remember one of the previous questions, we solved that also. What is the expected value of the option or expected benefit arising out of the option? Right. So, expected benefit from the option, expected value of the option. What did we compute earlier? This 65.85, which is in rupee terms. Okay, let me put this in rupees. What is this? This is the present value of the option. This is not the expected value. What they have said, what is the expected rate of return on the option? What is the expected rate of return in the option? So, that is, if you buy something at 65.85, what are you going to get? If you buy something at 65.85, what are you going to get out of it? What is the expected rate of return on this particular option? So, this again is a weirder part of the question, because if you already know that this is the future value of the option 67.5 and the present value of that is 65.85, because you have divided by 1.025%, which is basically 10% annualized number, 10% annualized converted into quarterly number is 1.025. So, the return of the option should be ideally 10%, no, on a per annum basis. See, what is the expected value here? Present value, future value. What is present value? Present value is 65.85. What is future value? Future value is 67.5. What is the return? 1.025. Return for 3 months. Minus 1 you have to do. So, you will get 2.5%. So, per annum return, okay, is 10% if you multiply it by 4. Now, the way they have solved it in the question is, because that the variation numbers are given in the 60 and 40, they have taken the probability of 60 and 40 to compute these returns. I actually do not think that is correct at all, because if you have already computed the P number here, you have to use the same probabilities. So, I actually think the answer is 10% here, because an option, when you have computed the present value and when you know the future value, it will only give you risk-free rate of return. It is a very poorly solved question in the study material. I think this is the answer. If you look at the study material answer, what they have done is basically they have computed the present value of option as 65.85 using another method, which is basically the replicating portfolio method or the delta hedging method, whatever you choose to call it. And after arriving at the present value of 65.85, what they are saying is there is a chance of this 150 going up of 60% and 0, that is CUCD, 0 of 40%, those are the numbers they gave, right, 60 and 40, correct. So, the future value is 90, the present value is 65.85, so the return is minus 1 if I do, 36.67% over a 3-month period. Array, but if you have already computed the present value of the option as 65.85, an option cannot give a different return. If you present value versus future value, you are actually going to get the same number of whatever is the discount rate. So I don't think that their way of doing this is correct, because a solution has to get the same answer irrespective of the method that you use. So if you are going to use the fact that this is 60 and 40, then we should not be computing P here at all. And if you are not computing P here, then you cannot even use a method like this. And if you are not going to use a method like this, you should not get an answer which is 65.85, but unfortunately they have got the same answer. So I don't agree with the institute solution. I think this is the correct solution. You actually should not do anything like this. You should say return over 3 months is 2.5%, per annum return is 10%. That is the correct answer if you ask me, right? So that is where we ended. Now let us move to the next one. Next question, friends. Ram buys 10,000 shares of X Limited, okay, at a price of rupees 22 per share. He buys 10,000 shares, 22 per share. Beta is 1.5, okay, and sells 5,000 shares, okay. So he is long on shares of X and short on shares of A. Sells 5,000 shares of A Limited at a price of 40 per share, having beta value of 2, okay. He went long on 1.5 beta, went short on 2 beta, okay. He obtains a complete hedge by Nifty futures at 1,000 each, okay. He closes out his position at the closing price of the next day when the shares of X Limited drop by 2% and shares of A Limited appreciated by 3% and Nifty futures dropped by 1.5%. What is the overall position or loss to Ram? So he basically did some transactions and he also hedged it using Nifty. Now some events have happened after the hedging activity. Because of that events, please tell me what is the value of the portfolio, correct? What is the overall profit or loss to Ram value of the portfolio? Very simple. Let us put the data in table. We'll again start solving the problem in a very, very easy manner. Okay, let's start. So friends, now let us first put the data in table. Ram buys 1,000 shares of X Limited. X Limited buy, or we can say long or buy, okay, just so that you know it, of 10,000 shares. So let me add a column here, shares and price, okay. 10,000 shares at 22 rupees. So is equal to 22 into 10,000 divided by 1, 2, 3, 4, 5 is 2.2 lakhs, okay, whose beta value is 1.5. This is the first one. Then he sells 5,000 shares of A Limited. A Limited, sell or short, sell, okay, 5,000 into 40 at a 40 per share, right? So is equal to 5,000 into 40 divided by 1, 2, 3, 4, 5. You should put minus because he is short on this, okay, and the beta is 2, okay. He obtains a complete hedge by Nifty futures at 1,000 rupees each. Obtains a complete hedge by Nifty futures. What does it mean? See, both of them have different betas, but the portfolio value is, somewhere here it is given basically what is the portfolio value. That is 2.2 is positive and he is short at 2. How did he hedge this thing? He obtains a complete hedge by Nifty futures at 1,000 rupees each. So let's say what is the value of the portfolio and what is the beta of this portfolio. If I think we first calculate that, I think then we will be able to answer the rest of the issue. So what is the value of the portfolio? Just sum it up, no? Is equal to sum 0.2. What is the beta? This into this plus this into this divided by 0.2, correct? 2.2 into 1.5, 2.2 lakhs into 1.5 minus 2 into 2 divided by 2.2 minus 2, correct? I think put the bracket ahead. So beta is minus 3.5. 0.2 basically is the investment value. See, when I purchased, I have to pay money. When I went short, when I sold something, I got the money, right? So, I got some money, I paid the money. So, the net difference is 0.2 lakhs, 20,000. But the beta of this entire position is minus 3.5, correct? Am I correct here? Yes, the position is minus 3.5. Basically, if the market goes up by 1, I will go down by minus 3.5. What is this weirdity? It is not weird. You have shorted a stock which has a beta of 2. Let us assume you have a, for a moment, don't assume short. Let's say you've gone long on a stock. If a beta is 2 for a stock, market goes up by 1, you will go up by 2, correct? Same stock you have shorted. So, if market goes up by 1, you will go down by 2, okay? Market goes up by 1, you will go down by 2. And on the other case, you have 2.2 which is beta of 1.5. So, basically market goes up by 1, this one will go up by 1.5. But if you look at the net position, 0.2 is the investment actually made which has negative beta, because the beta of your short position is more than compensating the beta of your long position. Very unfortunate, but that is what it shows. Now, for this, the person, whoever Ram, right? The Ram entered into Nifty contracts to hedge this position. If you have a negative beta, okay, if you have negative beta, let's say market, your portfolio and hedge. Market has beta of 1, your portfolio has beta of minus 3.5. Okay, portfolio has beta of minus 3.5. Irrespective of what happens to this particular market, you want your position to remain constant. Here when I am saying position, I am referring to the value, I am not referring to the beta. Market has beta of 1, your portfolio has beta of minus 3.5 and you want to do a hedge. Your portfolio is 0.2, your portfolio is 0.2. What should you do here with respect to the hedge? Because the market has beta of 1, the hedge position what you will take with respect to the Nifty index futures, if it is long you will have beta of 1, if it is short you will have beta of minus 1. But since you have a negative number here with respect to your portfolio, what will be the hedge position? You are getting my point. See, the hedge position here has to reflect the changes in the value of this portfolio should be compensated by the value of the portfolio here or value of the derivative here. Whatever happens to your portfolio should get compensated by the derivative that you enter. Your portfolio has 2.2 is the value of the portfolio and minus 3.5 is the beta. What should be the compensating position? You should do basically something where this minus 3.5 gets compensated to 3.5. So, basically index beta is 1. So, you have to do 3.5 times index transaction so that if index moves up by 1, this goes down by minus 3.5, this derivative will go up by 3.5 and minus 3.5 plus 3.5 get cancelled. So, basically you go long on Nifty 3.5 times the contract. But what is the basic contract value here? Here you have 0.2 lakhs is the position that you have. So, 0.2 into 3.5 is what you will do. So, the hedge here is hedge using Nifty is long. Okay, let me write it here. Long position. You will do 0.2. Okay, and 0.2, but the beta of the index is 1. So, you will do 0.2 into 3.5 or rather 0.2 into 3.5 so that these two compensate each other. So that these two compensate. How will they both compensate? You just multiply this by this, right? 0.2 into minus 3.5, you will get value of minus 0.7. 0.7 into 1, you will get value of 0.7. Both of them, if you add, become 0. The eventual goal is you should do a transaction in such a way that this minus 0.7, you add plus 0.7 so that the net impact on your portfolio is 0. So, you have to do investment of, or rather you should go long on Nifty futures for 0.70. Now, what is the next point that they said here? They said by using Nifty futures at rupees 1000 each. So, the price is 1000. So, 1000 into 70 will give you 70,000. You do 70 contracts at 1000 rupees each, so that your total contract value is 0.7. This 0.7 has a beta of 1. You multiply 0.7 into 1, you will get 0.7 again, which compensates for the negative portfolio beta of minus 0.7. You got that point? Negative value of minus 0.7 is compensated by positive value of 0.7 here. Now, I have put this here in the form of a table. How will you explain this in the examination? The way you have to explain in the examination is, first part of the table, okay, this part of the table till here it is clear, right? What have we said here? This part of the table we should say, total position as per existing transactions, okay. Should say total positions as per existing transactions is equal to 0.2 is the investment and minus 3 into minus 3.5 is minus 0.7. So, the hedge should be 0.7. Since each contract is for rupees 1000, or we can say contract value 1000. Let me even further clarify, rupees lakhs. Hedge should be rupees lakhs so much. Contract value is rupees. What is the contract value? 1000. Okay. So, if I slightly expand this row, 1000. So, number of contracts is equal to this into 1000 or this into lakhs, right, divided by 1000. You will basically say number of contracts is 70. That is what you are supposed to say. Now, is that the entire question? No, that is the first part of the question. What is the second part of the question? Second part of the question is, he closes out his position at the closing price of the next day when something happened. Okay. Let us see what happened. When price of X dropped by 2%, what did he do, a gentleman? Oh, so he bought something and that fell by 2%, A appreciated by 3%. So, he sold something, it went up by 3% and Nifty futures dropped by 1.5. So, basically, and he went long on Nifty, Nifty crashed. So, basically complete screw up. He thought something will go up, that fell down. He thought something will go down, that went up. He bought Nifty futures, they went down. All three contracts is basically made a loss. So, friends, you see here, what has basically happened is, even though they are supposed to have beta and all of that stuff, we mentioned that, there is a beta, they both will move together. In this case, nothing happened, right? Everything went ulta. Nifty dropped by 1.5, okay, and closing price the next day, the share of X Limited dropped by 2. See, X Limited was supposed to have a beta of 1.5, correct? That is what we wrote. Nifty dropped by 1.5 and this A Limited has beta of 2. So, it should drop by 3, it appreciated by 3, ulta. Okay, so what has happened is, here basically the link, the beta link, whatever is there, right, that broke. So, it happens sometimes. See, beta numbers are, as we discussed, right, are arrived after looking at a lot of data of periods, across a lot of periods, over multiple hundreds and hundreds of days of data is taken to arrive at a number which basically fits that particular, which broadly matches the correlations. Now, in this case, there is one case where it broke and everything went for a toss. Right, everything went ulta. What? Not only the beta broke, he entered into ulta contracts or the contra contracts, where whatever he thought will go up came down, whatever he thought will go down went up. So, it is a complete mess. Okay, and what they are asking us is, what is the overall profit or loss? After this entire mess, what is the profit or loss? Okay, so now we will just copy the top part of the table and replicate it here, so that we can actually understand what is that overall activity that has happened. Okay, let me put it here again, these 4 numbers, okay, or let me create a fresh table, right, that is easier. Okay, let me create a fresh table, and in this I do not think we require everything. First let me put the data. Part 2. Okay, company name, position. We don't read the shares and price, we directly need investment. What happened to that? Okay, market or performance. Okay, here beta is of no use. I mean, directly the details are given. Okay, so first we have, let me copy this data, and we had Nifty, right, where we went long, correct? Long 0.7, 0.7, or we can say change percentage. Okay. Now, what is the first thing that happened? X dropped by 2%. So, in this particular portfolio, if the share price drops, what happens to your portfolio value? Minus 2%. So, minus 2% is the change in the value of the portfolio. So, 2.2 lakhs into 1 minus 2%. Okay. It came down to 2.16 lakhs portfolio value, rupees value. Okay. Then A Limited appreciated by 3%. So, it appreciated by 3%, but then what have he done? We have actually shorted it, so we have lost there. So, what is the value of the investment? This is minus 2% into 1 plus 3%. So, your portfolio where you have shorted 2, you have lost another additional 0.06. You shorted 2 lakhs, you lost another 6,000 rupees. Then Nifty. Nifty futures dropped by 1.5. What is the change? Minus 1.5%. So, what is the loss here? Same thing, 0.7 into 1 minus 1.5. So, if you look at the value of the portfolio, what was the original value of the portfolio? 2.2 minus 2 is 0.2. So, what is the value of your portfolio? Value of portfolio is 0.2. Okay, now let us look at change in rupees. Here we have lost money. So, minus 0.04 is the loss. Same way here minus 0.06 is the loss. What is the loss here? This minus this, 0.01 is the loss. So, what is the total loss here? Total loss is 0.11. So, if you were to increase the value, or rather increase the decimal count, is 0.11450. So, on an investment of 0.2 what you had made, you have lost 0.11 because you have entered into a derivative contract and everything went haywire. So, the total loss on portfolio is rupees 11,450. All this is in lakhs, right? Change rupees lakhs, correct? Total loss on portfolio is rupees 11,450. Overall profit or loss to Ram is 11,450. See, here you should not try and complicate things beyond a level, by thinking what is happening to this, what is happening to that, how, if once you get one line item correct, right, simply follow the positions for other line items. So, for the first line item, you have decided how the profit or loss is computed. Just copy paste the same thing. Whatever you did there, do the same thing for the other two also. It is very, very simple, right? So, you've got a loss of 11,450. Very, very simple problem. Just that they have given multiple things and just to confuse you. Okay. Now, let us move to the next problem. So, now let us look at another question. A Limited of UK has imported some chemical worth of $364,897 from one of the US suppliers. The amount is payable in 6 months' time. The relevant spot and forward rates are given below. Spot rate, bid and ask, and you have been given US dollar so much. That means this is GBP USD. It is for 1 GBP how many USD? Okay, so when the bank buys GBP, they will give you 1.5617 US dollar. When bank sells you a GBP, they will ask you for 1.5673 US dollar. Same logic with 6 month forward rate also. The borrowing rates in UK and US are 7% and 6% respectively. So here also again they have given interest rates directly as 7%, 6%, which is not correct. You should always give interest rates per annum. So in one of the previous problems, we solved it directly taking whatever the rates they have given. It is incorrect. In this problem, we will solve them by taking them as per annum. Okay, because that is the right way to handle it, right? And the deposit rates are 5.5% and 4.5% respectively. Currency options are available under which one? Option contract is for GBP 12,500. That is, the contracts are quoted in terms of GBP. So if you look at NSE contracts, what we saw, in one of the previous videos, where, when you wanted to buy USD INR, you are resident in India, you wanted to buy dollars, okay? When you wanted to buy dollars, the contracts were quoted in terms of dollar. That is, for $1 how many rupees, right? They were not quoted in terms of for 1 rupee how many dollars, right? Whereas here in this problem, you're resident of what? UK, you have imported in US dollars, you have to pay US dollar currency. So the contract should ideally be quoted in terms of US dollar, but here they've given it in terms of GBP. So same like our Japanese yen problem, this is a slight twist. So you have to be very, very wary and careful of what is being given and what is being asked. Okay, then the option premium for GBP at a strike price of USD 1.7 per GBP is US dollar 0.037. This is a call option, and US dollar 0.096 for a put option for 6 months. So we will come to that. Call put, we will figure out. That is the least of the problems. We've already understood how we should do it. We will do that. The company has 3 choices: forward cover, money market cover, and currency option. Which of the alternatives is preferable by the company? Okay, so very, very simple, like what we did earlier, just that they jumbled and integrated 4 things and gave it to you. You should not at all get confused. You should follow logic. Okay, so solution. Okay, first let us finish off the forward cover and the money market, then we'll come to the currency option, that particular order. First, forward cover. And this is for how many months? Did they say? 6 months. Okay, exposure is how much? 364,897. Exposure US dollar 364,897. 6 months payable. Forward rate. Right? Forward rate. What is the forward rate? Let us come back. They have given 6 month forward rate 1.5455 and 5609. 1.5455 and 1.5609. This is bid, this is ask. This is GBP USD. That is, for 1 GBP, how many USD? This is the base currency. The banker bids to buy the base currency. What are you supposed to do? Banker is buying GBP, meaning banker is selling USD. You are resident of UK, so you need to buy USD. So if the banker is selling USD, you will buy USD. So the relevant quote is 1.5455. So amount paid in GBP on account of forward cover. So you need it in GBP terms. US dollar 364,897, right? 364,897 into, you have to pay it in GBP. So GBP should be in the numerator, USD should be in the denominator, right? This is what? This is for 1 GBP, how many USD? So for 1 GBP, 1.5455 USD, right? So you have to divide this. 364,897 divided by 1.5455. You will get GBP 236,102.879. So I will take as 88. Okay, you will get this. See, you can also compute this first of all by finding out the quote. This is what kind of a quote? This is an indirect quote. So USD INR for India is a direct quote, right? INR USD is an indirect quote. So for a resident in UK, GBP USD is an indirect quote. Okay, so this is an indirect quote. You can also do this by finding out the direct quote, and instead of doing 1 by 1.5455, you can actually find out the absolute value of 1 by 1.5455 and multiply it with that. That is also okay. But I prefer to move this way because this is more logical to me. Okay, then second option, part 2, money market hedge. Part 2 is money market hedge. Now, in money market hedge, what has to happen? If you remember, we have to buy dollars. That will become the last step. So if you remember, we need to have dollars so that we can use that particular dollars to make payment. So we should get dollars in hand. Get USD in hand. How much? 364 897. So I'll put this as dollars. That is, deposit matures in USD for 364,897. Right? That is interest and principal. Interest at the rate of what? US dollar deposit rate is how much? The borrowing rates in UK and US are 7% and 6%, and deposit rates are 5.5 and 4.5. So we need US dollar deposit rate, which is 4.5%. So here I will take 4.5% per annum. Interest at 4.5% per annum. Okay, so if you take 4.45% for 6 months, then you'll obviously get a different answer. Okay, we will take 4.5% per annum because interest rates are always quoted per annum. Interest rates are never absolute interest rates. The returns may be absolute. Interest rates are always per annum unless they are specifically mentioned that they are per month. Okay, interest 4.5% per annum. Right. So for 6 months, it will be 2.25%. Right. So principal will be 364,897 divided by 1.0225, right? That will be 364,897 by 1.0225, 356,867.48, and the interest will be 356,867.48 into 0.0225. Interest will be 8029.52, right? So these two total to 364,897. Does it match? Yes, it matches. 364,897. Okay, so principal is this. So principal is how much? 356,867.48. So if you have so much principal, where did you get that principal? You are a UK firm. How did you get that American dollars first of all in your hand? Because you exchange your UK, whatever is the money that you have, and you exchange it for US dollars on spot, and you got this much. So convert GBP into 356,867.48 dollars into this many dollars. So how much GBP exchange rate? At exchange rate, that is, you have GBP, you are selling GBP and buying dollar. So which rate will be applicable? Again here, banker is buying GBP, so you are selling GBP. So the first rate will be applicable, but the spot here 1.5455 is the forward. So don't use that rate. What is the spot? 5617. So 5617 at 1.5617 USD per GBP, right? So how many GBP? So GBP in hand is equal to 356,867.48 divided by 1.5617 USD per GBP. This is dollar. So dollar get cancelled. So you'll get the number in terms of GBP, right? So 356,867.48 divided by 1.5617. So GBP in hand is equal to 228,512.19 GBP. Okay, this also I'll highlight. Okay, so you have GBP in hand of so much. How did you get so much? You borrowed GBP 228,512.19 at, what is the borrowing rate for GBP? The borrowing rates in UK and US are 7% and 6% respectively. So we will take 7% for UK, right? So 7% per annum, at 7% per annum. So when you repay, you have to repay this. So the last step is get USD in hand of this much, repay GBP loan. How much is the GBP? At 7% per annum for 6 months. How much was the loan? This was the loan, 228,512.19. 228,512.19. Okay, so 228,512.19 into 1.035, right? 7% for half year. That is 228,512.19 into 1.035, right? That will be 236,510.116. So I'll take it as 1, 2. Okay, This is GBP. Okay, so this is the second one. This is 2, right? So the outflow. To get this much of inflow, you are having to give this much of outflow. 236,510. Right, now 236,510, how much was it with respect to your normal forward? 236,102. So this is still cheaper. Forward is cheaper than money market hedge. Now let us come to option. Option. Now option is where things get slightly convoluted. Need not worry. We have a logic. We will go by that logic. Currency options are available under which one option contract is for GBP 12,500. The option premium for GBP at a strike price of US dollar 1.7 for GBP is US dollar 0.037 for a call option and US dollar 0.096 for a put option. So for a moment we'll ignore this call and put. Let us come back to the thing, which is 12,500 pounds at 1.7 US dollar per pound. Option 12,500 GBP is a lot size, strike price is equal to $1.70 per pound. Okay. So if it is $1.70 per pound and it is 12,500 GBP, one lot in USD equivalent is equal to 12,500 GBP into $1.70 per 1 GBP. GBP will get cancelled. So 12,500 into 1.7. You will get $21,250 is one lot size. So lot size. What is our exposure? 364,897. US dollar 364,897. Lots required is equal to 364,897 divided by 21,250 is 17.17 lots. So we'll round it off to 17 lots. So 17 lots. So 17 lots is how much? 17 lots, that is 17 into 12,500 GBP or 17 into $21,250. Now if this is the case, how much amount is unhedged? Let us see. So if this is the amount that is hedged, amount hedged in dollars is equal to 17 into 21,250. 17 into 21,250 is $36,1,250. Amount unhedged is equal to 364,897 minus 36,1,250, that is equal to $3,647. Okay, this we will see how to handle the unhedged portion. Now let us first come to the hedge. So hedged portion $3,61250, or if you were to divide it by 1.7, 3,61250 divided by 1.7, you will get, that is equal to 212,500 pounds. Okay, we will keep this number as it is. When we come to the option, we will figure out. Right. Now, what is the option? What do I mean by when we come to option? What I mean is, here we have to enter into call option or a put option. See, it is $1.7 per GBP. So it is a GBP USD, because for 1 GBP, how many USD? Right, it is 1.7. So base currency is this. So you will buy or sell base currency. So if it is a call option, you will be buying pounds. If it is a put option, you will be selling pounds. What do you want to do here? You want to be selling pounds, right? So that you can buy dollars. So the option that is applicable for is put option. 0.096 is the put option premium for strike price of 1.70 USD per GBP. Base currency is GBP. So put option has to be entered into to sell GBP and buy dollar. Okay, so you have to buy dollars, right? So put option premium, put premium is equal to 0.096, and what is the currency they have given? 0.096 is what? 0.096 US dollars, right? 0.096 US dollars for what? For selling 1 GBP. So that you sell 1 GBP, you buy US dollars. So for buying US dollars, you will have to pay 0.096 USD for buying whatever is the equivalent US dollars for 1 GBP, right? So total put premium paid is how much? 0.096 USD multiplied by, for this is what? This is for selling 1 pound and buying $1, right? So you need to find out the premium that is paid. You can find it out in dollar terms or GBP pounds. We'll come to that later, we'll come to that in a minute, right? When we solve this, we'll get the answer for that. So total put premium paid. For selling 1 pound, you are paying this much, right? How many pounds are you selling? You are selling 212,500 pounds, right? So for 1 pound, this is the USD that premium that you are paying. So whereas you are selling this many pounds, so you have to multiply with this. If you multiply this with 361, 250, no, gone. So you have to multiply it with this, right? So what is the premium paid? 0.096 into 212,500. That is equal to your pounds get cancelled. You will end up paying in dollar terms. Okay, that is equal to $2,400. Total premium paid. Premium is paid on spot. So spot rate is, you have to buy dollars. What is the rate for buying dollars here? Spot rate. So this is the rate for buying pounds. The rate for selling pounds is, so when you buy pounds, the banker sells you dollars. So you have to buy dollars. So this is the rate, 0.5617. $1.5617 per pound, right? So if you want to convert this into pounds, so for 1 pound, $1.5617. So you have $2,400. So how many equivalent pounds? So you put it that way. That is, you put pound in the numerator and dollar in the denominator. I hope you guys are understanding why I am putting something in numerator and denominator. I am putting in denominator because dollar gets cancelled and you get the answer in pounds. So for 1 pound, the rate is 1.56. What is it? 1.5617, 15167. 1.5617. So I have to remove that 1. Would have made a mistake if I had taken 5617. 1.5617, right? So 2,400 divided by 1.5617, you will get, that is pounds 130.62.688. So I will take 69. This is the premium. Okay, because you are a UK company, everything has to be supposed to be in your currency, which is pounds, right? Then unhedged portion. Unhedged portion, we said it will be in the future, whatever is the expected spot, which is the forward rate that is available today. What is the unhedged portion? $3,647. $3,647 at what rate? What is the spot rate? You have to buy dollars. So same rate, 1.5617. $1.5617 per pound. So pound outflow is equal to 3,647 divided by 1.5617, that will be pounds 2335.275. So I will take 28. Okay, this is the unhedged portion. Then option exercised and consequent outflow is how much? Option is not for the full value. You should not get confused. Option is only for part of it. Right, you are having to pay the option when you are buying 361,250, you are getting, actually you are having to pay 212,500 pounds. So 212,500 is pounds, 212,500, that we already noted it. Then there is one more aspect we should not forget, interest on premium paid. If you remember, in one of the earlier problems, I said because the interest rates are not given, we need not bother about the upfront payment of option premium. On that, interest has to be computed, right? So we have not computed that. Here we can actually compute that. That is, interest on a premium paid is how much? What is the premium paid in? We will take this in pound terms only. Okay, 13062.69. $13062.69. What is the pound borrowing rate? What is the pound borrowing rate? Pound borrowing rate is 7% per annum. I said everything will take per annum. So 7% for 6 months into 7% into 6 by 12. That will be 13062.69 into 0.07 into 6 by 12. That will be pounds 457.194. So, I will take 19. So, this is D, this is C, this is B, then this is A. So, total outflow on account of option is A plus B plus C plus D, which is 457.19 plus 212,500 plus 2335.28 plus 13062.69. You will get 228,355.16 pounds minus 457.19. That is, if you exclude the premium or the interest cost, then you will probably get a slightly lower number. Okay, so this is option number 3. Okay, so now let us compare the 3 options: forward, money market and option. Not compare 3 options, 3 different ways of hedging. So, you will get 228,355.16 pounds, then money market is 236,510.12, 236,510.12. Here you can say star using or assuming interest rates are annual. Assuming interest rates are annual. Okay, if you have time, no, you compute the same option without annualizing the rates, then you will get a slightly different answer. You can write that down also. Okay, if at all you have time in the exam. I don't think many of you will have, but my logical suggestion is you should always assume interest rates are annualized. Interest rates are never given for a specific period, unless they are specifically mentioned. Unless they say the 6-month interest rate is 6% or 6-month absolute rate is 6%, unless they mention that. In our case, they did not do. What is it for forward? 236,102. 236,102 point something, right? 102.88. So, option is the cheapest. Option is the cheapest. So, option is the cheapest one. Friends, I actually realized that, I think we took even at one more place where, for the unhedged portion, we incorrectly took the spot exchange rate. See, when I was trying to solve the problem fast, I realized that the unhedged portion will be paid, or rather the, exchange rate should ideally be forward. What is the forward rate? Forward rate is whatever is applicable for spot, that is bid or ask. Same thing is applicable even for forward. So, it should be 1.5455. Whereas, when I was solving, I think I took 1.5617, correct? 1.5455 is the correct rate. So, there will be a small difference. Let us make that particular correction. So, what I will do is I will change this to 1.5455, and when you compute this number, revised number, what will happen is 3647 divided by 1.5455, what will you get? You get 2359.75. Now, with this, since this number B has changed, here when you do the total, that this total will also change. So, what will this total now be? This total will now be pounds. Let me add these numbers: 2359.75, right, then 457.19, then 212,500, then part A, which is 13062.69, okay, which is the premium. So, when you add all of this, 457.19 plus 212,500 plus 2359.75 plus 13062.69. Right, when you add all of this, what is the number that you will get? You will basically get pounds 228,379.63. Obviously, if you look at the study material, there is a question from the study material. They have not considered as interest, but logically I have explained to you also earlier that we have to consider the interest, right. So, this number will slightly change. 228 instead of 355, it will be 379.63. The answer, eventual answer is not going to change. That option is the cheapest one. That is not going to change. There is a slight, numbers. I think we have some, 20 odd pounds difference in the answer, right? So be careful when you are solving problems like this. When you are trying to be fast, when you are trying to be quick, when you are running short of time, you shouldn't make mistakes. All of us are prone to mistakes, okay? We should try and avoid them, okay? Now, there are some more problems like this in the study material. I am not solving each and every one of them. You can go through them and solve them. We will also add them as part of our illustrations, okay? Fair enough. Now, let's go to the next problem. So, friends, now let us look at the next question. On April 3rd, 2016, a bank quotes the following spot rate. So, they have quoted spot rate of okay, so here they have given bid and ask, very good, bid and ask. Spot rate, bid and ask, this is bid, this is ask, okay. And they have given USD and rupees, so USD INR, oh very good, direct quote. 2 months rupee swap points, they have specified that these are swap points, okay, so you have to basically add them. And 3 month swap points also they have given, okay. In a spot transaction, the delivery is made after 2 days. I told you when we were discussing also, spot means delivery after 2 days or settlement after 2 days, whereas cash and term means cash means today, term means tomorrow, spot means day after tomorrow. If assuming that there continuous days and there are no holidays in between. Assume spot date as April 5th, okay, 2016, some year. Assume one swap point is 0.0001. So they are referring to this as the swap point, okay. So when they say 70, the 70 directly gets added here, okay. When they say 160, it gets added here, okay. That is what they mean. Now you are required to do what? Ascertain swap points for 2 months and 15 days, okay. They have given you for 2 months, they have given you for 3 months. What is it for 2.5 months? We will figure that out, we will get to that. Determine the foreign exchange rate for June 20th. So once you get the swap points, you have to figure out what is the forward rate, because this is the spot, you have to add the forward swap points, then you will get the forward rate. Then compute the annual rate of premium or discount of US dollar on INR at an average rate. Okay, what does this average rate mean? We'll come to that. There is a slight, you have to be very careful when you read statements like this. So let us come to the point 3 when we reach there. But first, let us finish point 1 and 2, or rather parts 1 and 2. So solution part 1. What is part 1? Ascertain swap points for 2 months and 15 days. So bid, ask, swap points, okay. 2 months, 3 months, then 2.5 months. What is 2 months, 3 months? 70, 90, 160, 186. 70, this is 90, then this is 160, this is 186. Okay, so for 2 months is this, for 3 months it is this. What is it for 2.5 months? It will be exactly between those two. So you can actually take it as 160 plus 70 by 2, and you can call this as 186 plus 90 by 2. So because the average between 2 months and 3 months is 2.5 months. So for 2.5 months, it is just summation of those two divided by 2. That's all. It is very, very simple. 2.5 months swap points. What is 160 plus 70? 230. 230 by 2 is 115. 186 plus 90 is 276. 276 by 2 is 138. So 2.5 months swap points are this. So is that what they have asked? Yes, that's all. So the first question is answered. Second question, determine foreign exchange rate for June 20th, 2016. Part 2, forward rate for 2.5 months. Okay. Bid, ask. Okay. What is spot? 66.2525 and 67.5945. Okay, then swap points. So you have to add swap points. How much? 115. So you will add 115 here and you'll add 138 here. 138. They have said these are, each swap point is 0.000, 3 zeros and 1. So obviously you will add like this. Okay, I have drawn these lines just for your understanding. You need not draw them in the exam, but that is how you will add. Okay, so then what is the forward rate? 66.25. 2640 and 67.5 plus 8 is 13, 3, 1, then 8, then 10, 0, 1, 6083. 66.2640 and 67.6083. Very, very simple. There is nothing in this question actually. Okay. See, they themselves have said for June 20th, because here they have said 2.5 months is equal to June 20th, that is from 5th of April plus 2 months 15 days is June 20th. That is why I have directly taken swap points for 2.5 months, because forward rate for 2.5 months is, that is June 20th. Okay, that is why I have taken this. Okay, this part is also over, super simple. Now comes to the tricky part, part 3. Now let us come to the tricky part, that is part 3. What is the tricky thing here? Compute the annual rate of premium or discount on US dollar and INR on an average rate. So you see, now this is bid, this is ask, right? What have they said? Have they asked us to compute this annual rate of premium or discount on an average rate? What does this pertain to? Are they asking us 2 months premium rate? Are they asking us 2.5 months rate? Are they asking us 3 months rate? They have not specified that. So, are they asking us to compute on what average rate? Are they asking, this average is average of bid and ask? Is this average of 2 months and 3 months? Is this average of 2, 2.5 and 3? Is it average of spot 2, 2.5, 3? What is it average of? So, it's a very poor question, if you honestly ask me, poor way of framing a question, because they should specify average rate of what? Are you saying average rate of bid ask, or are you saying average rate across periods? So that clarity usually is, unfortunately is not given here. So 2-3 things that we can do. First thing is, if you remember, I told you that premia is usually not computed on average of bid and ask. Bid premia is usually different, ask premia is different. That is why you have 2 different swap points, no? Right, the swap points themselves are different. So basically the percentage is different here. So typically you compute the premia percentage also independently. For bid, what is the premia? For ask, what is the premia? Okay, so if that part is clear to you, that you have to compute this percentage separately, this percentage. When I say this, I am referring to bid separately, ask separately. Then one combination is out of the way. That is, should we do an average of bid and ask? So that part is out of the way. So that is out of the way. Then are we supposed to do across periods? Are we supposed to do for spot plus 2 months, 2.5 months, then 3 months, and making an average of all of those? Are we supposed to do this? That is really not clear. So what they have done in the material is they have taken for spot and 2.5 months. Okay, in the material they have done computed the average rate by taking average of spot and 2.5 months. I really don't agree with this logic, because nothing is stated in the question whether you have to take a spot and 2.5 months or spot and 2 or spot and 2 and 3. None of those are actually given out. Okay, so anyway, if we were to go by that logic, and the simple reason why I would, at least slightly be open to that logic is 2.5 is average of 2 and 3. So already you have considered the rates that are applicable for 2 as well as for 3, and hence 2.5 is what really helps you out. But they're asking you to take an average, so you might as well take it against the compare it with the spot. But again, that's a very, very weak logic if you honestly ask me. You should do it directly for 2.5. Okay, or you should do it for 2 and 3. Okay, if you do it for 2 and 3, you'll basically get 2.5 only. Okay, so you should do it for 2.5, or you should take all spot plus 2 plus 3 and all of that. So it is a very convoluted logic, but what they've done is they've taken average of spot and 2.5. So let us go with that particular approach. Spot is 66.2525. This is bid. This is ask. This is 67.5945 and 2.5 month forward, 2525, 5945, it's just cross checking the number, okay. Then 66.2640 and 67.6083, okay. Now premia is how much? 115 and 138, right? Right, so on average rate, so we take average of these two. Average for average rate, which is why I don't like, how can you take average of spot and forward? But anyway, average rate is equal to 66.2525 plus 66.2640 divided by 2, that is equal to 66.2583. Okay, I'm rounding it off to 4 digits. There is a 5th digit also, I'm ignoring it. And here it will be 67.5945 plus 67.6083 divided by 2. There you will get 67.6014. Okay. Now implied premium percentage is equal to 0.0115 divided by 66.2583 into 12 divided by 2.5. Here it will be 0.0138. Why am I taking not 138 and 0.0138? Because each swap point is worth 0.0001 rupees. Okay, so divided by 67.6014 into 12 divided by 2.5. Why am I multiplying by 12 divided by 2.5? This premium swap points or this premium or swap points are for 2.5 months. We have to annualize. They specifically said you have to annualize, which is why we are doing this. So if you do all of this exercise, what you will get is 0.0115 into 12 divided by 2.5 divided by 66.2583 is something into 100. That is 0.0833%. Okay, so implied premium percent, you have to also multiply it with 100, so into 100. Then what is the next one? 0.0138 into 12 divided by 2.5 divided by 67.6014 into 100, 0.09798, so 9799 percentage. Okay, so this is the implied premium percentage, implied forward premium percentage annualized. Fair enough. Now, as I said, this is not a fair way of asking a question because they have not specified what average you are supposed to take. But ideally, in exam, if you are confused like this, take average of, any couple of numbers or take 2 or 3 numbers and solve it out. Take average of spot plus 2 months plus 3 months. Take all 3 average. Ideally, the examiner should give you marks because the question itself is not clear. Okay, fair enough. Now, let us go to the next one. So friends, now let us go to the next question. This also is a fairly simple one. A USA based company is planning to set up a software development unit in India. Very good. So this is from out to in. Software development in India will be bought back by the US parent at a transfer price of US dollar 10 million. Very good. The unit will remain in existence in India for 1 year. Acha, this is only a 1 year story. The software will get developed within this time frame. So, the purchase price is given very clearly 10 million. The US based company will be subject to corporate tax of 30%, withholding tax of 10% in India. So, both these taxes are applicable and will not be eligible for tax credit in the US. Acha, okay. So, in US, when they take the money back, they will not get tax credit. So, they may have to look at other tax. Again, they will be taxed again. The software developed in the US market will be sold in the US market at 12 million. Acha, so the sale price is 1, but the transfer price is 10. Which one should we consider? Very interesting. So, we'll come to this. But very clearly, the sale price is 12 million, whereas the transfer price is 10 million. Other estimates are as follows. Rent for fully furnished unit with necessary hardware in India 15 lakhs. Manpower cost 80 software professionals will be working for 10 hours each day at rupees 400 per man hour. Administrative cost 12 lakhs. Advise the US company on the financial viability of the project if the rupee dollar exchange rate is 48 and assume 365 days in a year. So basically you've been given a set of cost. You have to convert them into rupees. They have also not mentioned any interest rate and all of that. Right. So if interest rate is not mentioned, what do we do? How do we figure out what rate we discount? Let us see, we'll see that. Right, they have said 365 days, that is okay. Then you have to simply compute whatever is the price realized minus the costs incurred, whether it is positive or not. And when you have price realized, should you take it at 10%? Should you take it at 12 million or should you take it at the transfer price of 10 million? That is a key question. Then tax, how do you treat tax? You have one corporate tax of 30% in India, you have withholding tax of 10% in India, Now this 30% of corporate tax, is this Indian tax or is this US tax? The US based company will be subject to corporate tax of 30% and a withholding tax of 10% in India. So this probably, it appears that this 10%, you see in India they will not have two taxes, no, they will have one tax, right? So in India this is again software developed in Indian unit will be bought back by the parent. Right, so this tax basically in India, whatever is the price at which they sell, on that there will be withholding tax. So the withholding tax will be on the transfer price, and the 30% tax that the US company is bearing on the overall profit will be on the profit that it generates, its overall profit, right? So what are we supposed to do? Advise the US company on financial viability of the project. So we should look at it from a US perspective and not necessarily from an India perspective, right? So we have to consider all India taxes, then take it back to US, and then in US you have to account for it, or you have to take it, remit it back to US, and in US we have to evaluate the project viability. And is there anything else that we are missing here? That and they very clearly said there is no tax credit available in the US. So this 30 is also there, 10 is also there. Okay, right? Fair enough. Let us go ahead and solve it. It is a very simple problem. There is nothing fancy in this, right? So friends, it's a very simple problem. There is, you don't have to do any present value or anything like that. Exchange rate is also single exchange rate, no beginning of the year, end of the year, no such complication. So let us solve it very, very simply. And first, let us look at manpower cost, because that is the only computation that is there in this question. Manpower cost. What is a manpower cost? They said 80 people, 80 hours per day is 10, days is 365, and rupees per man hour is 400. So if you multiply all of this, manpower cost, 8 into 10 is 800, 800 into 365 into 400. So you will get 11 crores 68 lakhs. Okay, manpower cost is this. Then you have what? Some rent and admin, right? Rent is 15 lakhs, admin is 12 lakhs. Rent 15 lakhs, admin is 12 lakhs. So add up all of this, you will get 11 crore 80, 11 crore 95 lakhs. Okay, this is the total cost. Is there anything else that they have asked or given actually? No. Right, now you come back to the question. So this 11 crore 95 lakhs is in rupee terms. What is Indian entity revenue? Transfer price of $10 million at 48 rupees per dollar. That is 10 million is 1 crore. 1 crore into 48 is 48 crores. That is rupees 48 crores. So revenue 48. So I'll put everything in crores. Then cost, I'll take it from here, which where we have already computed, right? 11.95. Right. So we have not been given depreciation, nothing else. So PBT, if you subtract these two, it takes 36.05 crores. So PBT is 36.05 crores. Now this PBT, whatever is the remittance, there will be a withholding tax. Now is this a separate entity or what is it? Set up a software development unit. Software development will be bought back by the US parent. Now, if I am not wrong, I said this 30% tax is of the US company. But is it very clear that this 30% tax is based in India or is it based out? I mean, this 30% tax is for the US entity per se, right? It's not 100% clear. So I think that this 30% tax probably is Indian tax, and on top of that there is a withholding tax of 10% India on remittance, right? Because if you are putting up a subsidiary in India, whatever profits are earned, on that you have to pay tax, right? So I think we should take that assumption because that sounds more reasonable, right? Less corporate tax at the rate of 30% is how much? 36.05 into 0.3 is 10.815 crores, right? So PAT is how much? Minus 36.05, you will get 25.235 crores, right? 25.235 crores. Now on this PAT, let us assume the full PAT is, whatever is the PAT is remitted. So, less withholding tax on remittance at 10%, right. So, into 0.1 is 2.5235. So, if you add those two, 25.235 minus 10%, you will get 22.7115 crores, right. Now, this is the amount that is remitted there, right. What is the amount received? Amount received in US dollar at 48 per dollar, at rupees 48 per dollar is 22.7115. This is crores into 10 power 7, right. A crore is 7 zeros divided by 48, and I will do this as 10 power 6, which is millions, right. Million is 6 zeros is what I told you, right. So, is how much? 22.7115 into divide by 48 into 10, right. You will get dollars 4.7315 million. Okay, this is the $1 million that they received, right. Now, when they are getting $4.7315 million, that is after considering this particular revenue, which is $10 million into 48, right. So, you basically are getting rupees crores, 48 crores. This is considering a transfer price of 10 million, whereas they are already after considering a price of 10 million as a transfer price and paying taxes, costs, expenses, they are already making a profit of 4.73. So, if you consider a transfer price of 10 million itself, they are making 4.73 million. If you consider the actual sale price of 12 million, they will actually make more profit. Another 2 million gets added, right. So, at TP of $10 million, profit before US taxes is $4.7315 million. If sale price is higher at 12 million, then profit will be higher. Right. So, this is the first part. Second part, if you look at the material, they have complicated things by saying first withholding taxes allows an adjustment, corporate taxes allowed as an adjustment, and all of that things. I don't think all of those are relevant because they themselves have mentioned that there is no tax credit. Right. Now, that they have mentioned that the tax credit is there for withholding or corporate, all of that they have not clarified. The question says there is no tax credit, right. If you come back and see the question, and will not be eligible for tax credit in the US market. So, is it only of the withholding or is it of the corporate tax that is paid in India also? All that clarity is not there. So, here we can write an assumption: withholding tax of 10% has no tax credit, and corporate tax in India of 30% has no tax credit. Okay, these are two assumptions. Now, if any of these assumptions change, obviously this entire working will change, right. Here anyway I have given you or we have computed before tax profit, before US tax profit. Now, if there is tax credit of this 30% whatever they have paid in India, right, where is this? This 10.815, then obviously this will be the after tax profit because you will not be paying tax again. Right. If you have, let us say there is additional corporate tax in US, then this 4.736 will come down further, and then you will again have this extra 2 million that you are getting it from higher sale realized. So, there are multiple combinations. If you remember in one of the problems I was telling you, don't work on so many combinations. Please give them as assumptions, right. You can give at the most 2 answers. You should not give 6 answers and say if whatever evaluator you want, you take this. That is not the right way, right. So, you basically have 1 or 2 answers and state out your assumptions very, very clearly. If you have time, if you have a lot of energy, then please give 6 answers. Otherwise, please restrict yourself only to 2 answers, either this or this. Okay, fair enough? Chalo. Now, let's move to the next problem. So friends, now let us look at problem on caps, right? Slightly different version than what we've already done. XYZ Limited borrows 15 million pounds of 6-month LIBOR plus 10% for a period of 24 months. So the interest rate is 6 months LIBOR plus 10 for a period of 24 months. The company anticipates a rise in LIBOR, hence it proposed to buy a cap option from its bankers at a strike rate of 8. So the strike rate is only for the LIBOR. The lump sum premium paid is 1% for the entire reset period. The fixed rate of interest is 7% per annum. So this is something new. This is something new. I'll explain what it is. The actual position of LIBOR during the forthcoming reset period is as under. So for the first period 9, then 9.5, then 10. You're required to show how far interest rate risk is hedged through the cap option. For calculation, work out figures at each stage up to 3 decimal points and the amount nearest to pound. It should be part of the working notes. So fairly, these are all irrelevant things. The key thing in this particular question is the lump sum premium is 1%. See, I was telling you that typically the premium is paid upfront. Okay, typically the premium is paid upfront, whether it is cap or floor or collar or whatever it is. Typically interest is paid upfront. But here they have said the lump sum premium is 1% of the entire reset period. The fixed rate of interest is 7% per annum. This is a slightly convoluted statement. Here, what they mean is, for the entire reset periods. So they've used this language that the premium paid is for the reset period. So here the premium is not paid in lump sum in advance, but it is paid again in installment basis. It is paid in installment basis for the respective periods, right? And these are equal installments. Now this is a concept that is there in the material. I'm not trying to go and delve deep into how it is arrived, what it is arrived. I think it just pays for you to just remember the formula. It's a fairly simple formula, nothing complex. Right, because I have not seen this kind of stuff, at least I have not worked on this kind of stuff. Probably that it exists somewhere in the world, but I have not worked on this, so I am not aware of how it works, or I've tried to search where the literature where such kind of stuff happens, but I'm not been able to figure out. So I'll give you what is there in the material. It's nothing fancy, it's a very simple concept. Let's, I'll explain, when I explain you'll understand what it is. Okay, so first let us write down the data. Solution. First, loan, how much? 15 million pounds, 15 million. Then 6-month LIBOR plus 10%. 6-month L plus 10%. 2-year loan. Okay. And again, here they have not given day convention and all of that. Okay. So let us leave it there. Then bankers proposed to strike cap option from its bankers. Hence, it proposed to buy a cap option from its bankers at strike rate of 8. Cap at 8%. Okay. Then you have this whole thing, premium. Okay, premium. So first, these are all very simple things. Let us now come to premium. Premium is equal to 1% paid over the period. Paid over the period. Right. And they have specifically said actual position of the LIBOR during the forthcoming reset period. So there are 3 reset periods. Okay, for the first reset period, as we discussed, for the first period, or rather the first for which the first interest is there, that is already predetermined. So there is no concept of cap or anything like that, right? Whereas for the next 3 periods, this is available. So what you will do is, the formula is premium is equal to premium percentage into loan value divided by present value interest factor, cumulative present value interest factor for this 4 periods. At what percentage? These are half yearly rest, right? So for half of period, and they have said that this 7% interest per annum. So this rate is to be used to discount or compute the present value factor so that you can figure out what is the EMI. So that is the logic. Right, at 3.5%, not 7%, 3.5. Why 3.5? It is 7 is per annum. Here these are half yearly rest. So at 3.5%. So this is simple equated premium. Right. So how this is computed now? 1% into loan value is 15 million pounds divided by present value interest factor for 4 periods, 3.5%. So that is PVFIA 3.5%, 4. Right, so 1 by 1.035 is equal to once, twice, thrice, 4 times, and then you do GT. You will get 15 million, 1%, 15 6 zeros, right? Of that, when you do 1%, is 2 zeros goes away, right? So 15 plus 15 into then 4 zeros, that is 1,50,000, right? So 1,50,000 If you're getting confused, you just type 15 million into 1%, okay, divided by 3.673. They said how many decimals? Up to 3 decimal points. So 3.673. So equated premium will be divided by is equal to into 1,50,000. You will get 408.37, and they have said ignore the decimal points. So we can take 408.37 pounds. So now period H1 we are not aware, H2, H3, H4, LIBOR. What are the LIBOR rates given? 9%, 9.5% and 10%. CAP is at what rate? 8%. Okay, CAP is at 8. So all 3 dates the CAP actually gets hit. So effective rate, then max 0, rate actual minus rate of the CAP, right? So this is max 0, rate actual 9 minus 8, right? So CAP payoff, right? CAP payoff. So 9 minus 8 is 1%. So I'll just delete this and I'll say 1%, here 1.5%, here 2%. Total interest rate, right, is LIBOR minus CAP plus 10%, right? So LIBOR minus CAP, right? So LIBOR minus CAP is all 3 cases, it will be 8%. 8 plus 10, 18%. Okay, then. So friends, now that we have computed the 18% the effective rate, let us go back to the question and see what is it that they are specifically asking. You are required to show how far interest rate risk is hedged. So I think we have to show the interest before the cap and the payoff of the cap and after the cap. So let us go back and now draw another table in addition to the table that we have drawn above, and let us see H2, H3, H4. Because they've asked what is the impact of the option, so you should give interest before option, interest after cap option. Okay, so we will split this into 3 parts. Okay, and here you can split it like this and say this is interest before cap, cap payoff, right? This is percentage, this is pounds, this is also percentage, this is pounds, and interest after cap in pounds. Okay, so this will give us the impact of the cap payoff. Okay, now if you look at this, what is the interest before the cap? See, you had directly, what was the spread? Spread was 10%, no? So you can directly take 9 plus 10, 19, 19.5 and 10, right? 10 plus 10, 20%. 3 of these are the rates. Now, and our loan is how much? Loan is 15 million. So 15 million is 6 zeros. 15 million into 0.19 divided by 2, right? You will get this also. I can actually put it as million, 1.425. Okay, then 15 million into 1 by 2 into 19.5% is 1.4625 and 20% is 1.5. Okay, this many million is the interest before the cap payoff. Then what is the cap payoff? We have figured it out here. 1, 1.5 and 2. 1, 1.5 and 2. Right. So what is the cap payoff? You compute again same 15 million into 1 by 2 into 1% is 75,000, 1.5% is 112,500 and 2% is 1,50,000. Okay, here I have given million and not given in million. Okay, after cap, what is the interest? 1.5 million minus 1,50,000. This is also, I will put it in million. This will be 1.35, or I'll actually expand. Why million? So the interest here will be 1.5 million. That is 15 and 5 zeros, right? 15 and 5 zeros minus 1,50,000 is 13,50,000. Then 1462500 minus 112,500 is 13,50,000. Then 142530 minus 75,000 is equal to 13,50,000. So after the cap, the interest in all cases 13,50,000, which works to 18%. So if you want, you can actually compute 15 million into 18% divided by 2, that is 13.5. So this is what is the impact, right? The cap payoff has changed the or the inflows have come in because of cap, which reduced the interest rate to 13.5 million, which works to 18% per annum, right? Now, what is the other aspect? They've also given this premium, right? So interest cost, net interest cost after premium, right? H2, H3, H4, interest less cap premium, net interest. Okay, all of them are pounds. Okay, 13,50,000, 13,50,000, 13,50,000, and we already computed the premium here. What was it? 40837. 40837 and 40837. Right. So what is the net interest cost? You subtract 13.5 minus 40837. 13,09,163. In all three cases, 13,09,163, 13,09,163. Okay. So you actually get, these are the inflows, cap payoff. So if you want, I can actually write inflows. This is outflow. This is outflow. Right. So from the bank, you will basically be getting these three and you will be basically paying this. So if you want, you can actually add one more column, net payment to bank, payment stroke receipt from bank, cap payoff, inflow, premium, outflow, net received. What is this? 75, 112,500, 15, 1,50,000. 75, 112,500, 1,50,000, 40837, right? So net received is 75,000 or minus 40837 plus 75,000 is equal to 34,163, 112,500 is equal to, the difference between these two is 37,500, right? So I just keep adding 37,500. 34,163 plus 37,500, 71,663 plus 37,500 is equal to 109,163. Okay. So the total is 75,000 plus 112,500 plus 1,50,000, that is 337,500. Then 40837 into 3 is equal to 122,511. If you subtract this minus 337,500, you will get 214,989. So this is what they have asked. What have they asked? You're required to show how far interest rate is hedged through cap option. This is what is the impact of interest rate cap. You've got a benefit of this. This is the benefit. Okay, this is the benefit. Okay, fairly lengthy one, but in terms of number of tables that we put, but all of this is simple computation. Okay, so you write a summary. Benefit from using the cap is pounds 214,989 as the cost is reduced from 337,500, which is increase in interest rate. Okay. So, this is the answer that you get. Fair enough. Let us move to the next question. Let's look at the next question, friends. Delta Limited's current financial year's income statement reports its net income as 15 lakhs. Delta's marginal tax rate is 40% and its interest expense was 15 lakhs. So, PAT is 15 after subtracting 40% tax. So, 15 by 1 minus 40, which is 15 by 0.6, which basically is 25. 25 lakhs is PBT, then PAT is tax is 10, which is 40% of 25, and then PAT is 15. Then before PBT also had interest expense of 15. So, then EBIT is 40, right, of which then the company has 1 crore of invested capital, of which 60% is debt. So, 60 lakhs is debt, 15 lakhs which is the interest cost divided by 60 lakhs of debt. So, I think 15 by 60 lakhs you will get 25%. Oh, that is a very high number. Okay. Interest expense was 15 lakhs. Oh, it looks very high. Anyway, in addition, Delta tries to maintain a WACC of 12.6%. Compute the operating income or EBIT. We have already computed EBIT. What is economic value added? We have to do the same logic what we did earlier. And then it has 2,50,000 shares outstanding. How much, according to the EVA you computed in 2, how much can Delta pay in dividend per share before the value of the company would start to decrease? Okay, same thing like what previous one. If it does not pay any dividends, what would you expect to happen to the value of the company? If it does not pay, value will increase. That's all. What is there? Anyway, it is very similar to the previous problem. Let's go ahead and solve. I don't think it will take much time. Okay, friends, this is Delta Limited, right? First thing you are supposed to do is compute operating income or EBIT. So, I think we can compute that. What is the number? Net income, post-tax net income. So, PAT is how much? 15 lakhs. 15, 1, 2, 3, 4, 5, right? Tax rate they have said is 40%. So, PBT is PAT by 1 minus tax, right, which is 15 lakhs divided by 1 minus 40%, which is 25 lakhs, okay. Then interest is 15 lakhs, interest 15 lakhs, right. So, PBIT is summation of these two, which is 25 lakhs plus 15 lakhs, which is 40 lakhs. So, have you finished the first part of the question? Yes, compute the operating income earned in the current year. What is economic value added? What is economic value added? EBIT into 1 minus tax rate. EVA is equal to NOPAT minus capital charge. NOPAT minus capital charge. NOPAT is equal to EBIT into 1 minus T, which is, what is EBIT? 40 lakhs into 1 minus 40%, which is 24 lakhs. So, I will give this as rupees, right. NOPAT we have already got. Capital charge. What is invested capital? They themselves have given invested capital of 1 crore, right, 7 zeros. 1, 2, 3, 4, 5, 6, 7. Okay. Then WACC. They have said WACC is 12.6%. 12.6%. So, capital charge is product of these two, which is 1 crore into 12.6, which is 12,60,000. Okay, so EVA is 24 lakhs minus 12,60,000, which is 11,40,000 in rupee terms. Then Delta has 2,50,000 equity shares. According to EVA, you computed how much Delta can pay in dividend per share. So, max dividend that can be paid in total is 11,40,000. Max dividend per share in rupees is the next one. We will say share count. What is share count? 2,50,000. Max dividend that you can pay per share is 11,40,000 by 2,50,000, which is 4.56. Can I increase the, there is nothing beyond this. Max dividend per share in rupees is this much. Then, if Delta does not pay, what do you expect to happen to the value of the company, right? So, if it does not pay, we expect the company to have higher value. If dividend is not paid, amounts will be retained and EBIT will increase, and hence company will have higher EVA as well as value going forward. Dividend is not paid, amounts will be retained and EBIT will increase. EBIT will increase. Why? Because you are pulling back the money into the business. Increase, and hence company retain, EBIT will increase, and this company will have higher EV as well as value going forward. That's all. Nothing else. Okay. Let us move to the next question. Let's look at the next question, friends. AFC Limited wishes to acquire BCD. So, this is acquirer versus target. The shares issued by two companies are 10 lakhs and 5 lakhs. Issued means here it is issued capital. Okay. Number of shares, and this is share count, not in terms of rupees. Calculate the increase in total value of BCD. Okay. Resulting from acquisition on the basis of following conditions. Current expected growth rate of BCD is 7%. Expected growth rate under control of AFC without any additional capital investment and without any change in risk of operations is 8%. Acha, growth rate will grow by 1%. Okay. Current market price per share of AFC is 100 and current market price of BCD is 20. Expected dividend per share is 0.60. So, expected dividend means this is directly D1. Oh, so they are using here D1 by K minus G. Very interesting. So, we have D1 here, we have growth here. So, you can find out the cost of equity. Super. Very simple question actually. Right. Then, on the basis of aforesaid conditions, calculate the gain or loss to the shareholders of both the companies if AFC were to offer one of its share for every 4 shares. Now, here gain or loss to the shareholders. So, do you want to say it in terms of market value? Do you want to say it in terms of per share? You can do both. Okay. If it is gain also, per share gain or loss, you can say on a per share basis or an overall basis, we can say both. I think in one of the previous questions, we did only per share, we can do it both on the market value basis also. Calculate gain to shareholders of both the companies if AFC pays 22 for each share of BCD. Assuming P ratio of AFC does not change after the merger and EPS of AFC Limited is 8 and that of BCD is 2.5, it is assumed that the AFC invests its cash to earn 10%. Now, let me reread this. Calculate gain to shareholders of both the companies if AFC pays 22. Oh, here it means pay, that is cash outflow. There is cash outflow. In the previous one, there is a swap. Here, there is no swap, there is cash outflow, which is why they have given, they earn 10% on cash. So, whenever there is a cash outflow, there is a money going out. So, they will lose interest, right? But then you will also gain EPS. So, we have to see that. Assuming P ratio of AFC does not change after the merger, EPS of AFC is 8 and that of BCD is 2.5. It is assumed AFC invests its cash to earn 10%. Now, this 10% is pre-tax or post-tax. Ideally, they should give tax rate separately. We will, in our assumption, we will take this as a post-tax rate. Why are we taking this post-tax rate? You will understand when I show it to you. Okay, had they given a tax rate somewhere, no, it would have been good, but they unfortunately have not given, so it is not an issue. So, here we are supposed to find out after making the payment, there will be some EPS, based on that EPS there will be a price. On that price, what is the pre-merger value per share versus post-merger value, you compute the difference, whether there is any gain or loss for AFC, you will compute. Same way for the other BCD also, for equivalent shares, what is the value pre-merger, and for equivalent shares, what is the value pre-merger, and post-merger, what is it that they are getting per share, you compare both of them and then you see whether there is gain or loss. This is also a simple part. So, which is why I said this question is fairly simple, just that, they have given, just randomly thrown too many numbers, we will have to make sense of that, that is all. Okay, let us go ahead. Friends, let us start off this solution. We will have two companies, AFC Limited pre-merger, okay, then BCD pre-merger. I will just say pre here. Why do I need to say a pre-merger and all? Pre is sufficient, most of us will understand. Then ABC post. Correct? Then share count 1, 2, 3, 4, 5, 6 and 1, 2, 3, 4, 5. Post merger, we will see what is the thing. Calculate the increase in value of BCD resulting from acquisition in the following conditions. Expected growth rate. Okay. G of BCD pre-merger is 7%. G of same BCD post-merger is 8%. Then current market price in rupees is 120 and D1 of BCD is given as 0.6. This is also rupees. So, we have this formula, no, which is P0
is equal to D1 by KE minus G, correct? So, what is the market price? Market price is already given. So, 20 is equal to, what is D1? 0.6 divided by KE, KE we do not know, minus G. What is G? G is, so now this current market price of 20 is pre-merger, right, and this is expected to go up, this is expected to go up. So, we will take the current pre-merger 7% growth rate only as the right number for computing the market price. Why? Because market is usually not aware of all these acquisitions and all. See, in real life, you have rumors and all of that, but legally market is not supposed to be aware of the merger till the announcement is made. Okay, or 20 by 0.6, right? 20, or we can take KE minus 7% is equal to, KE minus 7% is equal to 0.6 by 20. Right, or KE minus 7% is equal to, what is 0.6 by 20? Is 0.03. KE is equal to 0.03 plus 0.07. That makes us 0.1. So, which is 10%. K is equal to 10%. We've got cost of equity. Now, what is the specific question? Calculate the increase in total value of BCD Limited resulting from the acquisition. Now, you've got KE is 10%, right? Now, P0 if growth is 8%. So, here in this part, I actually have a slight difference of opinion in the way they have done, right? See, we already know that D1 is 0.6, right? So, what is D0? Especially considering the growth rate is 7%, is 0.6 divided by 1 plus 7%, correct? So, D0 is 0.56, right? So, if G is 8%, then D1 will change, no? Obviously, when you are changing the denominator, even numerator will be taken into account. So, D0 is 0.56, D1 at G of 8% is 0.56 into 1 plus 8%, okay, 0.605. Now, or 61 you can take, I will put them all in 4 decimals, 6056. See, I have just found out D0 and I have recomputed D1. Why have I computed D1? Because they themselves have said that the D1 is 0.6, but they are saying after it comes into the control of another company, the growth rate will change. So, when growth rate is going to change, obviously you have to consider different dividend, no? Right. So, then, and we already have cost of equity, we are assuming there is no change in cost of capital, assuming no change in KE, P0 is equal to D1 by KE minus G, which is 0.6056 divided by what is KE 10% minus G, which is 8%, which will give you 30.28. What was the price earlier? 20. From 20 rupees it went up to 30 rupees. This is brilliant, right? Price has gone up to 30.28. Now, in the material they have not assumed it that D0 is this one. They have directly taken D1 as 0.6. Okay, I don't subscribe to that logic because expected dividend is future dividend will change based on the earnings, right? And if they change based on the growth, based on the earnings growth, dividend will also grow. So, P0 is 30.28. According to me, this is a right way of solving this. Okay, now first part is over. What is the second part of the question? On the basis of aforesaid conditions, calculate the gain or loss to shareholders of both the companies if AFC were to offer one of its shares for every 4 shares. Acha. Now, swap ratio, gain stroke loss to shareholders. So, if you remember this, guys, when we were computing gain or loss, we did both on market price basis as well as an EPS basis. We should do this also. If at all I have forgotten it somewhere, I would strongly recommend that you do gain computation both on EPS as well as market price basis. Okay, because in some of the earlier problems we did that way, and that is correct. That is logical, right? Swap ratio 1 for 4, right? Right. So, existing share count of AFC is how much? 10, right? New shares issued based on swap ratio is for every 4 shares 1. So, this divided by 4, basically issuing 1,25,000. So, revised share count post merger is summation of these two, right? 11,25,000. Okay, if AFC were to offer one of a base, we will calculate the gain or loss to the shareholders. Now, are we given the EPS numbers? We've only been given the current market price, right? We have not been given the EPS values. So, if EPS and values are not given, how will you compute gain or loss on EPS? So, that is not required. But on market value, or rather on the total value of the company, the market value of the company or market value of the share, either ways you can compute, right? So, we have got a revised share count post merger as 11,25,000. So, friends, I think in the first part, no, they specifically asked for calculate increase in total value of BCD resulting from acquisition. I think we just computed the price and left it there. I think we should not do that. We should actually compute the increase in value. Okay. So, pre-merger value of BCD in rupees. What is the value pre-merger? You have 5 lakh shares at rupees 20, which is how much? How many zeros? 7 zeros, which is 1 crore. Pre-merger value of BCD is 1 crore. Then post acquisition by AFC value of BCD in rupees. This is 30.28 into 5 lakhs, which is 1.51 crores. So, increase in value of BCD in rupees is 1.51 crores minus 1 crore. You basically get 51 lakhs 40,000. Okay, this is the answer to the first part. I think I missed that particular specific point. I realized it when I was actually looking at what is the question for the second part. Right, that is when I realized it. Anyway, coming back. So, revised share count post merger is 11,25,000 for both the companies put together. Now, what is the specific question? On the basis of the aforesaid condition, calculate the gain or loss to shareholders of both the companies. Now, you have to compute the gain or loss to shareholders of both the companies. And what is the swap ratio? 1:4. So, revised value of both companies together is how much? Is not ABC and this is AFC. I think this also I made a small error. So, now what is the revised value of both the companies here? You can directly take this 1 crore into, this is 1 crore or 10 lakhs? 10 lakhs. 10 lakhs into 100 is basically 10 crores, right? So, this is the value of AFC. Okay, so let me copy that and paste it here. This is 8 zeros, this is 10 crores. And for BCD value, what is the value? We have computed here. Post acquisition, the value of the company will increase to this much, which is 1 crore 51 lakh. So, the combined value is these two, which is 11 crores 51 lakh 40,000. Why is this relevant? Because we need to find out new share price in rupees. What is new share price? Is post merger value divided by the revised share count, which is 102 rupees. Okay, this you can probably round it off to 2 decimals. Right. Now, value per share or price per share pre-acquisition is 100 for AFC, no, and post-acquisition is 102. So, gain in percentage post-acquisition. Did they say forcing gain loss to shareholders of both the companies? They said shareholders. So, it can be in percentage basis of the market price. They have not given EPS. So, let us not bother about EPS, or it can be market value also. Either ways, gain in share price post-acquisition in percentage is 102 minus 100 divided by 100, which is basically 2.35%. This is for ABC. Now, equivalent shares in ABC, or rather let me say share price post acquisition is how much? 102 is 102. Then let me put equivalent shares. Equivalent shares of BCD for share in AFC is basically 4, no? The swap ratio is 4, right? 4. So price per share of BCD swapped is how much? 102.35 divided by 4, you get 25.58. Price per share of BCD pre-merger is how much? That also was given somewhere here, no? Where was it given? Current market price is 20. So, gain for shareholders of BCD post merger in percentage is 25 by 20 minus 1. They have got 27.93%. Now, I have given this in percentage terms. Can you do this in rupee terms also? So, if you do this in rupee terms, gain in rupees per share is how much? It's simply 102 minus 100, 102.35 minus 100, which is 2.35. Here, what is the rate? What is the gain? Gain in rupee terms. What is the gain? So, you basically have 25.58 minus 20, which is 5.58 per share of BCD. Gain in rupee terms per share of ACF will be 4 times of that, which is 4 times of this, which is 22.35 rupees. So, gain in rupee terms per share of ACF is 22.35, and this is for whom? This is for shareholders of BCF or BCD. Names are very confusing, guys. Shareholders of BCD and shareholders of ACF, AFC, AFC. Okay. Okay, this is done. Gain in terms per share of AFC. So, this part is done. So, we completed the second part of the question. Now, what is the third part of the question? Gain to the shareholders of companies if AFC pays rupees 22 per share. So, this is cash outflow. Okay. Assuming PE ratio of AFC does not change after the merger and EPS of AFC is 8 and BCD is 2.5. So, market price per share is how much? We already have it. 120, then this is rupees, okay, then EPS per share in rupees, how much? They said 8 and 2.5, then PE is 100 by 8, which is 12.5, and 20 by 2.5, which is 8. So, this is a higher PE. Now, calculate the gain to shareholders of both the companies if AFC pays rupees 22 for each share of BCD. So, instead, what is the combined PAT? Do we have combined PAT? Yes, we have combined PAT. No, we already have EPS. Then we need to compute share count. What is share count? We already have it in share count in numbers, which is, where is it? Yeah, 10 lakhs and 5 lakhs. So, PAT in, you can do rupees lakhs is 10 lakhs into EPS and 5 lakhs into EPS, you basically this. So, you do a combination of these two, you get combined PAT, right, of 92 lakhs 50,000, right. Calculate gains to shareholders of both the companies if so and so. See, now in this you should not get confused that there is a increase in growth and all of that. That is only for first part of the question. For part 3 of the question, all that is not there. So, this is part 3. If you want, I will actually write here. Part 3, and it was part 2 here, part 2, prior to that was part 1, right. So, combined PAT is 92 lakh 50,000. Now, this combined PAT is there, but cash is going out. How much cash is going out? Less interest cost on cash paid, and I will say this as post-tax interest cost. If you remember, I said post-tax interest cost. Why? You see here, cash paid computation. What is cash paid? Per share consideration in rupees, number of shares. What is per share consideration? Is 22 rupees, and number of shares is how much? We have 5 lakh shares, correct? So, total cash paid is 22 into 50, which is 1 crore 10 lakhs, right. Interest cost at 10% per annum on this is 1 crore 10 lakhs into 10% is not 1 crore 10 lakhs. This is
Let me put commas here. That is the way you will, it will be easy that way. This is 1 crore 10 lakhs. Yeah, this is 11 lakhs. So, interest cost is 11 lakhs. So, combined PAT less post-tax, interest cost on tax paid. So, this is 11 lakhs, right? Revised PAT. Revised PAT is how much? 9 lakh 25 minus 11 lakhs, which is 81 lakh 50,000. Okay. 81 lakh 50,000. This is revised PAT. Okay. Now, this is revised PAT. What have you done? Instead of giving shares, you have paid cash. So, if you have paid cash, no shares are allotted. If no shares are allotted, then the old share count will continue. So, share count of AFC post. Here, the share count will be old share count, which is your 10 lakhs. Right. So, revised EPS is 8.15 and revised PE ratio is how much? Old PE will continue is what we said, no, 12.5. So, revised market price is how much? 8.15 into 12.5, which is 101.875. Now, this 101.875 for shareholders of AFC, there is an increase. So, what is the specific word? Calculate gain to shareholder of both the companies. So, gain to shareholders of AFC in terms of market price is 101 divided by 100 minus 1. Why divide by 100? 100 is the pre-acquisition price. So, you are basically making 1.88% in terms of market price per share in percentage. Okay. This is the gain in market price. Now, do we have to give overall value? Calculate the gain. Okay. If you want to calculate the gain, that can also be done, right, which is per share increase in value in rupees, which is this minus 100, 1.875. Share count is 10 lakhs. Total value increase in rupees is 10 lakhs into 1.875, which is 18.75 lakhs. Okay. Total increase in value. We have given it both in value terms as well as percentage terms. For shareholders of AFC is 18,75,000. This all is shareholders of AFC only. This is part 3. Part 3. Gain to shareholders of AFC Limited. Okay. Then we have to compute gain to shareholders of BCD. Gain to shareholders of BCD. Current market price in rupees 20. Cash received in rupees 22. Gain in rupees minus 20, which is 2. Gain in percentage is 2 by 20, which is 10%. Okay. Gain in total value in rupees is this 2 rupees into total number of shares that they have, which is how much? 5 lakhs, which is basically rupees 10 lakhs. Okay. So, we have given in all dimensions, whatever they want, we will ask, we will give. Beyond that, nothing else is required. Right. Revised EPS, and here in the first one, we have not given the gain in EPS terms. If you want, we can give that. Increase in EPS terms is 8.15 divided by what was the original EPS? By 8 minus 1. So, which is 1.88%. And market price also has gone up by 1.88%. In EPS terms also has gone up by 1.88% only. Okay, fair enough. This concludes this particular problem, and only thing you have to note in this is we have considered D0 and D1, whereas they have not done that in stability. Okay. Hello friends, my name is Sriram and I am your faculty for paper 2 Strategic Financial Management SFM. Here below this line, these are all inefficient portfolios or suboptimal portfolios. But I am telling you why they are inefficient or suboptimal. Why? Because for same level of risk, you are getting higher return in some other portfolio. You will pay 600, get a share back, and that share you can sell in the market at 1000. So each warrant is worth 400 rupees. And how many warrants are you getting per equity share? You are getting 1. So 400 into 1 is 400. So that is the value of that particular warrant. So the value for Zomato, what they are saying is, we value the delivery franchise at 2.5 times FY26 GMV. We are in FY21-22 and they are valuing it at 2.5 times the GMV in 2026 financial year. I will give you enough tools to help you understand a lot of stuff. If you were to revise it frequently, you will remember the key points. We will give you some mnemonics. We will give you some ways to remember, but there is no need to mug up. I believe that we both together can work on all these three things: concepts, practical application, and examination science.